Good.
How many people are expected, Arun?
About 150 is what we're expecting. So far, only 20 have logged in, but they come in towards the last moment, actually.
Yeah, we've still got 15 minutes to go.
Yeah, because the SCI, their conference room is presently empty. So I think by the around 3:55 or so, along with the CMD, everybody is going to join in. Some
Shipping
15,
Corporation.
20, yeah, Shipping Corporation of India.
Yeah.
So 15, 20 chairs I was watching, they just requested me to just focus. They wanted to focus their camera, actually.
Okay.
Yeah.
Yeah, I know.
Okay, so I will go on mute and join as soon as
Right.
you want me to.
Okay.
Good afternoon, Mr. Arunji. Good afternoon, Arunji.
Hi, good afternoon, Rajan.
And good afternoon, Mr. Bhargav, Akshay Bhargav. Nice to see you.
Hi, Raman. Good to see you.
Yeah, and also JS. Good afternoon to everybody.
Hi. Good afternoon, sir.
Good afternoon, Rajiv. Good afternoon.
Very good afternoon, sir.
Rajan was the chairman of Rashtriya Chemicals and Fertilizers in Bombay, and he's now part of our overall team. Right, I think I am also going off. I'll come back later.
I'll start at around about 3:54 because I'll take just a couple of minutes before I hand it over to you, Mr. Arun sir. Around 4:04 I'll hand it over to you.
PPMD should be brought in. Yeah. What do we get? About ICIC number, I'll get it. Only the mental notes. Yeah, I've asked for that category.
Rajiv, I would suggest you start at around just around 4 o'clock because let some more people come in.
Regions.
Oh, okay, good enough.
That is our standard.
At 4 o'clock.
Start at 4 o'clock. We should have minimum 100 people.
Yeah, that's true. ठीक है, sir.
Yeah. You just give it a 3. No problem.
ठीक है सर, ठीक है, फाइन सर, फाइन सर, फाइन सर।
Hello, Prasanna. I can see you and hi to you.
He doesn't have the right to unmute himself, no, sir. Maybe that must be the reason.
Okay, fine. Let it be. Let it be.
Initially, I have given
don't
the
change.
right. I will stop it at 3 p.m. Sorry,
Oh,
4 p.m.
4. Yeah.
So I have
Yeah,
given the
don't
right.
change anything.
First,
Yes.
yeah, first 3 minutes. Yes.
Okay. Okay.
Good afternoon, Madhavan.
Good afternoon, Arun. How are
Good
you?
afternoon. Good
Hi.
afternoon.
I had to take a jacket out of dust.
Yeah, operating from home, you don't use a jacket at all.
Yeah. Well, I operate from work, but don't see the need to use a jacket right now. So,
Hi, Arun.
Hi, Revati. Nice hearing your voice.
Yes, yes.
hey, Revati, long time no see.
Yes,
Madhavan.
hi.
Madhavan here.
Oh, hi. Nice. Hey. So good to have you here, Madhavan.
Thank you. How are you?
Yeah, been a while.
I know. How are the
Haven't seen
grandchildren
you.
doing?
Grandchildren are all doing good, Madhavan. All good.
Rajiv, we can start now, no? Another minute or so.
Yeah, fine. Good enough. Good evening, Ms. Revati. Very good evening to you.
Good evening, good evening.
Sorry, in the night I saw your message pretty late.
No problem. I sent it to many people.
Yeah.
WhatsApp is easy to send, no? Because otherwise people forget. So and a lot of people said they'll just join in. Let's see.
Chalo, ladies and gentlemen, very good evening to you. On behalf of Institute of Directors, I am honored and take the responsibility to welcome you all to this webinar. I am Brigadier Rajiv Kapoor, the Regional Director for IOD Bangalore and your host for today's evening session. Let me first thank and express our sincere gratitude to all the sponsors who have come forward in making this event successful. The first on the list is the Coal India Limited. It's a Maharatna and a state-owned coal mining corporate, which came into being in November 1975. Kiran, can you put on the slide, please? With a modest production of 79 million tons, and today it is the single largest coal producer in the world. It functions through its subsidiaries in 85 states of India and has 345 mines, which include 151 underground, 172 open cast, and 22 are mixed. Presently, it is also operating 13 coal washeries and is also one of the largest corporate employers with more than 2.5 lakhs manpower on its roster. It also has a foreign subsidiary in Mozambique, namely Coal India Africana Limited, that is CIAL, and has also acquired two new subsidiaries, that is CIL Navi Karnia Ujra Limited for development of non-conventional and renewable energy. And the second one is CIL Solar Power Photovoltaics Limited. Apart from the above, CIL has also manages other establishments like hospitals, training institutes, vocational training centers, and conducting multidisciplinary programs and health schemes. We thank the management of CIL and other senior dignitaries for getting associated with IOD. Ladies and gentlemen, the second in the list is the Mahanagar Gas Limited, that is MGL, is an enterprise of Gas Authority of India, popularly known as GAIL. Again, a Maharatna company of Government of India and Government of Maharashtra. It is a natural gas distribution company which was instituted in the year 1995. It has a diversified base of supplies for its domestic consumers and has taken an initiative to bring in clean, safe, efficient, and affordable piped natural gas with a diversified piped natural gas of supplies for domestic consumers, that is 6 lakhs home in Mumbai. An industrial consumer through a network of 136 CNG stations, thereby contributing 800 tons of reduction in pollution on a daily basis. I sincerely thank the management of MGL for getting associated with us. And also I extend my gratitude and appreciation to all the dignitaries of both the powerhouses by taking our time to join us for this webinar. Thank you very much. And in the meantime, like this is the fourth, but the second of the quarterly regional webinar in the current financial year hosted by Institute of Directors. These webinars are tuned to introduce subjects of current interest to sitting board members as well as for those who are aspiring for the board positions. The topic for today's webinar is risk management, and the theme is, can the board or the risk committees deliver? As we all are aware that the ongoing pandemic has disrupted life across the globe, and understanding risk and how to mitigate its impact has become a recurrent subject in the board conversation. Today, we have invited some of the country's well-known experts to talk about their experiences on their strategies in managing risk across various sectors. The structure for today's webinar shall be as follows. I shall be introducing the speakers and then inviting them to address the audience. Once each speaker has delivered his address, there will be a short question answer session for the audience, which will be conducted by Mr. J. Sundaresan. He is our in-house compliance guru. And the next will be the keynote speaker, who shall be delivering his address for approximately 30 minutes, while other speakers shall be sharing their experiences for 15 minutes each. After all the speakers have spoken, there will be a question answer session for the audience for 10 to 20 minutes, which shall again be moderated by Mr. Sundaresan. A general point for the consideration of everyone: to avoid any background noises which may cause distraction, we have put everyone on the mute mode. However, you can enter your questions and comments in the chat box, or subsequently you can ask the questions by using the icon on the control box. That is by raising your hand. Throughout the presentation, the address, someone from the staff shall be managing the chat box functionality. Let me now request Shri Arun Balakrishnan, Chairman, Institute of Directors, Bangalore, to start the proceedings with his inaugural address. Mr. Balakrishnan has been the former Chairman and Managing Director of Hindustan Petroleum Corporation Limited, popularly known as HPCL, which is a Fortune 500 company. He has also been the founding chairman of HPCL Mittal Energy Limited, that is HMEL, an oil refining company conceived as a public-private partnership. Over the years, he has been on the boards of over a dozen companies and has chaired various board committees such as Audit, Risk, Nomination and Remuneration Committee in both public and private sectors. May I now call upon Mr. Arun Balakrishnan to kindly start the proceedings, please?
Yeah, thank you very much, Rajiv. And good evening, ladies and gentlemen. It is my pleasure and privilege to welcome you to this webinar on risk management with the theme, Can Risk Committees Deliver? This is the fourth of the series of quarterly talks organized by the Institute of Directors, Bangalore. We have drawn the best of speakers from various sectors to give our audience a feel of how risk is managed by them. You will therefore get a broad spectrum view of risk and mitigation strategies in this online seminar. There is a risk of my preempting the learned speakers by delving too much in detail in my opening remarks. So let me confine myself to one rather simple story on investment risk I had faced in the recent past. Like most of you, I too invest in equity, any surplus money that I may have. But of late, equity prices have reached stratospheric levels and continues to grow higher each passing day. So I asked my investment advisor her view on the wisdom of adding more to the equity kitty. Her reply was, please stay invested and continue the SIP in select scripts and not to worry about the current prices too much. She saw my dazed look on her computer screen and said, oh, let me explain. In summary, what she said was this: the profile of Indian industrial economy has changed in the last few years and is continuing to change at a rapid pace thanks to the pandemic. Most of the MSMEs have shut shop for want of bank credit, and the businesses have moved to the larger companies in the organized sector. And these companies have cut costs and improved profitability by rapid digitization and reducing redundant workforce. These changes, she said, are reflected in two fronts. One is the higher profits we see in the quarterly results, and the second is the steady increase in GST collections month after month. And she put out two tables to back up her claim. She concluded by saying, if you're putting your money in the top 100 nifty companies, you're safe. To my mind, that was a sample of risk management in action. She had analyzed all available data, looked at such incidents in the past, and arrived at a way forward, but with some conditions. It was then my call what options to take. What about the MSMEs and the mom and pop stores, I asked her. She said most of them are gone and are unlikely to come back in the near future. That in any case, she said, is someone else's risk and not mine. It will become my risk, she said, only if the government does not find ways and means to help those who have lost their livelihood. And there is a social unrest and violent uprising. So, ladies and gentlemen, the question is, can risk committees deliver, as my financial advisor has done? And if so, what is the call boards have to take to protect their companies? Our star speakers, I am sure, will have their own stories to tell about how they are managing the risk that they face in these difficult times. So thank you, ladies and gentlemen. And over to you, Brigadier Kapoor, to lead the way forward.
Thank you very much, sir. Thanks a lot, sir. Now, ladies and gentlemen, let us focus towards our distinguished speaker for the day, Mr. Akshay Bhargava, who shall be delivering the keynote address. Mr. Akshay Bhargava is the founder and executive chairman, Bridgeweave, United Kingdom. Bridgeweave is a fintech firm that uses AI models to provide institutional quality research signals and investment ideas to investors, advisors, and asset managers. Bridgeweave's flagship product is Investors AI, available on the mobile phones for end investors in equity markets. From 2014 to 2017, Mr. Akshay was the global CEO of Wealth and Investment Management, Barclays PLC, a business with 200 billion pounds in client AUM, that is asset under management. Prior to that, he founded InfraHedge, a hedge fund managed account platform, which was acquired by State Street Corporation in 2013, and now is the world's largest platform with over $43 billion in AUM. He has been the CEO of Butterfield Fulcrum Group, acquired by MUFJ Group, and also the founding CEO program, which was acquired by Infosys and renamed as Infosys BPO in 2006. He started his career at Citibank, where he spent 22 years in a variety of senior roles. Country manager, Citibank Czech Republic, global product head for Citi's ELC business, regional GTS head for CMEA region, and other senior roles in product management and corporate banking. He's an alumni of IIM Calcutta and now lives in London. May I now call upon Mr. Akshay Bhargava to kindly come forward and start the proceedings for the keynote address. Over to you, sir.
Thank you very much, Rajiv. And Arun, it's a great privilege to be here talking to all of you. And thank you for inviting me to speak. It's also a personal privilege for me to see some old familiar names like Ganesh, who I have not seen for, 20 years almost, old NASCOM days. So great privilege to be speaking. You know, my title of my talk is Challenges of Managing Risk, but I will confess that I was challenged myself while putting this presentation together, because I'm speaking to an informed audience. I'm talking to people who have incredible operating experience, people in operating jobs, people as board members. So there's an amazing amount of experience here. So how do you tell anything to an experienced audience that they haven't already heard? So what I thought I would do, I would focus, instead of telling you 3 ways to manage risk or something like that, I would just provoke thought. And if all the next few slides do is cause you to think, then I have succeeded in part. Again, today's focus is the board, so I wanted to focus a little bit on the role of the board risk committee, which I happen to chair in Mindtree. You know, board risk committees are a very necessary component of good governance, and which then in turn places a very important obligation on the BRC to deliver. And very appropriately, the theme of today's session is, can board risk committees deliver? But delivery really is a question of what is expected. And, you know, this is a really a non-trivial question. You know, and you can spend a lot of time talking about it. But in my view, let us start with the classic role of the BRC. I don't know if you're seeing these red lines on this. Let me stop sharing my screen, and I will share it again in the hope that they will disappear, and they have disappeared. So, so the classic role of the BRC, and I took this from the charter of the Infosys Risk Committee from their annual report, is to assist the board in its governance and oversight duties by identifying, evaluating, mitigating operational, strategic, and external environmental risks. Now, you may think that this is a great definition, and it is. It's reasonably complete. It addresses many things that risk committees tend to do. But how do you actually operationalize it? And there is so much change in the environment today that, old definitions don't really work. Now they work to a limited degree. So if I really look at it, I was reminded of this famous quote from Donald Rumsfeld in 2002. Now, at the time he said this, a lot of people made fun of him, and they but I think that had more to do with his own personality. But taking the humor of the context and Rumsfeld apart, what he really said is there are things you know. Okay, then there are known unknowns, which are things you don't know. And finally, there are unknown unknowns, things that we don't know, that we don't know. And it is really the last category of risks that tends to be the really difficult things that, if you can see something that's coming, you can deal with it. If you know something that you don't know about, you can find out more about it. But if there is something you have never thought of, and how will you ever find out things about things you haven't even occurred to you yet? So this, for a long time, this was used as a way to describe risk. Known, unknown, unknown, unknowns, etc., etc. But if I really look at practical life today, I think world is much, much more nuanced. And the way I think about it, I think some of the most dangerous risks are what currently seem remote. And let me explain. Take cybersecurity. There is no board on earth that will tell you that cybersecurity is not a risk. It is a risk. It is a huge risk. But I also believe, and this is based on conversations with literally hundreds of people, everyone thinks cybersecurity is something that will happen to somebody else. And if it happens to us, then we'll find a way to deal with it. And I'm not saying there is an element of complacency, but there is an element of not understanding and frankly, not being frightened enough. That's where I come out on this. And I read recently about ransomware. I started reading a little bit after last week's ransomware attack on Accenture, where I think a significant chunk of data was compromised. And I think the ransomware company sent a $50 million demand to Accenture to pay them, otherwise it would be gone. What I did not know, that India is at the top of the global attack list with respect to ransomware. In India, and I'm talking only India, companies have been attacked, IT companies have been attacked, hospitals have been attacked, all kinds of businesses have been affected. And what was shocking to me is that 67% of Indian companies have paid. And the global average for this number is 32%. So I don't know what is going on in India or why India is the center of attack. But I just feel that as I talk to companies, as I talk to my potential customers, there is just not enough concern about ransomware and cybersecurity. And not a lot of people realize that work from home has increased the vulnerability because the spread of what is available to attack has gone up exponentially with so many people working out. Now, the question is, what do you do about it? And I think that is a subject by itself. But what I wanted to say today, the purpose of this slide is really that there are things that we are aware of. But I think when we start looking at the impact, we are constrained by anecdotal evidence of what has gone on in the industry. And there is most people who pay for ransomware don't talk about it. So much of this is like an iceberg. You see the top, but you don't see the 90% bottom. And this is a very, very big risk. And I'm convinced if everybody thought of it the same way, they would react to it very differently. And in the same vein, I want to be a little provocative and give you 3 risks that I see. And these are mega trends that I believe could change everything in the world, everything how we know it. And I just think that people know about these trends. They get written about all the time. You can read newspaper every third day, there's somebody writing about it. But I think the impact of these things is not well understood. And these 3, one is what I call a digital-only consumer. This is not a digital customer. This is not a millennial who uses a mobile phone. This is somebody who does everything on a digital device. He is a digital-only customer and will simply not engage with other forms of communication. There is quantum computing, which we all have read about. I'm not an expert at all, but it's arriving fast. And finally, there is central bank digital currencies. And having worked in financial services industry, I am terrified of this, because this could upend economies. This could upend monetary policy. And let me talk a little bit about them. And these are very, very large risks. And I will draw a conclusion from them as I go forward. So let me take the digital-only consumer. These are really the Gen Z and, or the millennials or really young people today who want to do everything on the mobile. In my company, we did a little experiment. We sent an email to about 5,000 people. And we sent a text message to another 5,000 people of similar profiles. Our email response was 0.25%. Our text message response was 6.5%. And that is an example of how emails are going out of fashion, just like letters went out of fashion some years ago. There's a bunch of people who will simply not read an email, no matter what it says. Okay. If I look at the industry that I'm engaged in, investments and wealth, there is a generation of customers emerging who will not do anything other than a mobile. So if you give them an online application or some other way of doing, or you call them, they don't want to talk to you. They don't want to deal with, in fact, because of that, they don't even trust banks and institutions. And I think once this cohort gets critical mass, they will vote with their feet by simply choosing not to engage with traditional models of finance and advice and investments and wealth management. And what 5G will do will just increase the velocity of this change by just making it so much faster and so much easier to do everything on a mobile. And the regulatory challenge of conduct risk, of good outcomes for the customer, will multiply because you no longer have control of the channels through which the customer is engaging. So I see this as a very, very big risk for many companies. The second thing is quantum computing, where computing power becomes incredibly plentiful and incredibly cheap. What that means is any encryption code that is effective today will be useless because it will be breakable in seconds. Now, of course, you could argue that new encryption code will come up which will survive that technology, but that is quite likely. But just imagine Y2K, where one digit was changing, caused havoc. Now, in reality, nothing much happened, but the amount of effort that went in anticipating and fixing that problem, caused huge changes in the industry. The entire IT industry in India became credible because of that one event. And of course, I'm oversimplifying, but that helped a lot. And I think quantum computing will be similar because everything will have to change. Everything. And I'm afraid the biggest innovators in the segment will be cyber criminals because they will see the biggest opportunity. They will not be governed by any regulation. They will have all the money to invest in the latest technology and hire the brightest minds who are bright and unprincipled. And I think this could create the kind of risk that we cannot understand today. But equally, there will be business opportunities, there will be revenue opportunities, there will be growth opportunities that will emerge from this new technology, as with most other technologies of this kind. And finally, the one I'm really scared about is central bank digital currencies. And I don't know how many of you are familiar with it or have had a chance to read up. Please do. There are some excellent reports and research reports going around. What this means is that all of a sudden, cryptocurrencies or Bitcoin and Tether and things like that will not be issued by private individuals, but will be issued by a central bank. Now, unlike a note or other forms of money supply, where the custody of that money supply belongs to the bank, the issuance of that money supply belongs to the central bank. There is the difference between custody and issuance disappears in crypto, which means that all individuals in the country will have their savings accounts with the RBI. Now imagine that. Because there's no need for an HDFC bank. There is no need for any other bank to exist, because you can directly have an account with RBI. All transfers will be instantaneous because all the accounts are in the same place. Okay, bank deposits, as we understand them, will have no purpose because there is no question of safety of money. Now, if banks do not have deposits, how will they lend? So the balance sheet management and liquidity management of a bank, is completely upended on their heads. Will we even need banks? I don't know. Maybe we will need NBFCs who are loan arrangers, who are marketplaces that connect sources of funds with users of funds and sit in the middle providing risk management and governance and control services. And they are not banks as we understand them today. Then linkages, because of this nature, linkages between markets and monetary policy will be broken, and there will be new instruments of monetary policy that will emerge. I mean, if you start to think about it, your head hurts, because there are so many possibilities in ways this could go wrong. But again, it will create risk. It will create opportunities. All commerce will change. What I'm trying to say is that if I'm a company and I'm in the board risk committee and I'm thinking about these things, admittedly far-reaching as they are, what should I do about them? And I took a little time to think about it. I would be asking 3 questions. Do we know enough to model possible risk scenarios from this trend or technology, whatever it is I'm looking at? Secondly, does it create big enough benefits for our company to be an early mover? And the mirror image of that does being late to the party become a major threat? And if you're able to answer these questions, then I would look at it in this manner. That would allow me to evaluate and challenge intersections of these things. So if you know enough and this is a big opportunity, then we must develop a strategy to take advantage of it. If we know enough and there are big potential threats, then we have to mitigate actively, and we have to think about how we can mitigate that risk. If we don't know enough, but we think there are big opportunities and there are big potential threats, then we have to watch very closely to decide when to act, and we have to learn. And if all 3 intersect, in other words, we know enough about this risk, we can see the big opportunities, we can also see the big risk, then you have to act today. There is no case for waiting and losing time on this one. Anyway, so I mean, like I said, the purpose of what I'm saying today is more to provoke thought than to give you a prescription and this is what you must do. I think every company, every board, every risk committee has to decide what it must do. And somebody asked me when I showed them this presentation, they said, why is the background man and a machine and AI and stuff like that? And part of it is because this is what I do. But part of it is, I think in the future, the interaction of human and machine will play a massive role in effective risk management, because without technology, the human cannot do it. And technology alone will never have the judgment to take the decision. And I genuinely believe that is the future. It may be some time away, but when I think that, I'm always reminded of William Gibson, who said the future is already here. It is just not evenly distributed. So with that, I thank you for your time. And like I said, I hope it has caused you to think. And if it has done that, then I'm very happy.
Thank you very much, sir, for your views on the risk management. Ladies and gentlemen, we are now open to the question answer session. May I request Mr. Sundaresan to review the questions posted, and I request him to elicit their reply from our distinguished speaker. Over to JS, please.
Thanks, Rajiv and Akshay. That was an amazing presentation. And I have a quick question for you. There are a lot of people across industry here. So if they were to have a risk management committee, in your view, what should be the first 3 agenda points for discussion?
Look, it's a great question and caused me to think. Look, I think if you never had a risk committee, the first task is to identify the major risks of today.
Yeah.
Okay. then you must have a framework for evaluating those risks. That which is important, which is not important, and so we don't waste time chasing shadows. And thirdly, when you have identified the major risks, you have to have a clear mitigation plan. Forget the future. Abhi to aaj ka risk, identify karna hai. So we have to, if you're starting out, you have to look at what is the most important risk of today, figure out a framework of continuously evaluating and then mitigating that particular risk. So those are the three things I would say that need to be done.
Yeah, brilliant. Yeah. So I have a question from Daman. He says, there are a lot of large corporates which do not have a risk management function. What do you perceive of this, and what do you think can go right or wrong for these companies?
In a facetious way, I would call Arun and I say, Arun, find out these companies and sell. Don't hold that stock. Look, frankly, I think everybody has a risk management function. They may not call it risk management. In many cases, the CFO plays that role. A wise and experienced CEO and a chairman will play that role. The board will play that role because that is part of being successful in business. So I cannot see a successful company who does not manage risk well. They may not call it a risk management function, but they will be managing risk in their own way. But I think more importantly, I think now we see the risk committee is a well understood function. The function of the risk committee changes. So if you're in a bank, for instance, your risk is not just financial risk and other risks. The biggest risk is regulatory risk. Your second biggest risk is doing harm to your customers. And the third biggest risk is your own balance sheet that, do you have enough liquidity to meet all the demands on the asset side? So the nature of the risks will change depending on what business you are in. But I just find it hard to imagine any company who is blissfully ignorant of risks and is doing well.
Okay, while on that, let me ask you another one. Are people confusing between this audit committee and risk committee? In the sense, can both coexist?
They both must coexist, and both do coexist in a very beautifully collaborative manner. I think risk committee is a subset of audit committee, the way it is constructed everywhere. And I speak for myself as the chairman of the risk committee for Mindtree. We have our own meetings, and we report to the audit committee. And then we, of course, report to the board as well. So this is just a devolution of authority that should exist in any well-structured board. Because ultimately, all these committees, be it audit committee or risk committee, what is their role? To help the board in its oversight and oversight function for the company's operations. So I think there is no conflict between audit and risk. In fact, I see great complementarity.
So what do you think a risk committee should discuss, which an audit committee need not discuss? Why I'm asking you this is, many a times it happens that, people say, okay, anyways, audit committee is the committee which is the core committee, and risk committee passes it off to, I'm just saying. And
I hear what you're saying. Look, the first thing I will say is that there are many people in this call who are far, far more qualified and experienced than I am to answer that question. But if I may say so, look, if the risk committee is not taking its function seriously, then that's a problem in and of itself. What it cannot do is abdicate responsibility to a higher committee. Then the audit committee can do the same with the board, saying, look, we are just a committee. The board is the ultimate responsible. Why should we care? You must care. You have a fiduciary obligation and a duty to do this. And I think the process of natural challenge and response is a very healthy one. So if, for instance, the audit committee feels that risk committee is either not focused on something properly or not gone into enough detail, it must probe, it must challenge, and it must satisfy itself that the risks have been properly identified and the appropriate actions have been taken. And similarly for the board, if it ever feels that the audit committee hasn't done what it's supposed to do, it must challenge and probe and satisfy itself.
Yeah. Lakshmikant is asking you a question, which is how to value financial loss from cyber risk. I thought first
once cyber risk happens, it is very easy to value financial loss.
No.
But what you have to value is what can happen. And if that happens, the loss is not always financial. The loss is reputational. I mean, look at Accenture. Last week, this thing happened. Nobody's going to forget about it for months until the next big one comes along. So it is not always a financial loss. It is the distraction that the company faces. It is the stress that is created within the system. It is the reputational damage that happens. There are many aspects to this. That's why I worry about cyber risk much more than, risk of losing money or a bad debt or something like that. That's finite. It's controlled. You can write it off and you're done. Cyber risk, you're not done, and new ones will emerge every day.
Okay. Gopal, one of the senior guys, are asking, in your experience, did any company in the world predict COVID type of risk and prepare a mitigation plan?
Ask companies in Wuhan, maybe they did. I don't know. The COVID is a black swan event. How could you ever predict COVID at the scale and breadth at which it happened? You can't. We all say it's a once in a lifetime risk. I just hope it is once in a lifetime risk. I don't want to see any more in my lifetime, for sure.
So from that, let me take a cue. So post-COVID, do you think the risk committee's job is to evaluate the mitigation plans and other things, and how does that work?
I will give you a non-traditional answer. Of course, the risk committee's job is to manage mitigation plans and whether somebody is dealing with it all right. But I think there are bigger challenges coming. I mean, take work from home, which happened because of COVID. One of the biggest implications of work from home that I personally believe has not been sufficiently understood because it hasn't been experienced as yet is the lack of connection that the employee feels with the company. Let's say you're an IT company in India, you employ 1 lakh people, and let us say your attrition is 20%. Then in the last 15, 18 months, you had 30,000 people who are brand new to the company, who have never been to the office, who have no idea what the company looks like, has never worked there. 30% of the company hasn't done that. Wait one more year, it will go up to 50%. Then half your company has never been to the office. How do you create a feeling of belonging and engagement with the company? These are very, very big risks, potentially, especially in India where large companies employ a lot of people. I don't know how to deal with that, but I worry about them a lot. Even in a small company like mine, which is like 45 people, even there, I worry about people who have now worked with us for a year, who've never met anybody else from the company.
Yeah. So Margaret has a question. She says, you mentioned about cryptocurrency, Bitcoins, and that there would be no banks and central bank to manage. What would happen to futures and options or interest rate markets?
Good question. There are futures and options and derivative markets on crypto. So you can buy a forward contract on Bitcoin or something else. But they pretty much operate in the same way. The real challenge what is happening in the crypto world, it is legitimizing at lightning speed. It is legitimizing so fast that you cannot even understand. I certainly cannot get my head around it. Every time I read in the papers, JP Morgan is going into crypto, Citi is going into crypto, Vanguard is looking at the crypto index fund, and where is all this coming from? And that is legitimizing the cryptocurrency industry. But it is still a fringe activity. It doesn't really affect mainstream. The moment the Bank of England says that we will create the crypto pound, and you can hold it in an electronic wallet, and you can use it for anything you want anywhere in the world, and we will control and make sure the transaction goes well. What does that do? I don't need a bank any longer. I can pay my suppliers in India with that. I can pay my employees with that. I can ask my customers to pay me with the crypto pound. I just don't need the banking system any longer. it will change the accepted order. And that is what is the scariest thing about what is happening. And these are just some things that people wiser than me have thought of, and I've just read about it. There are things that nobody has thought of. And my fear is that the first people to think about it will be criminals who will immediately try and figure out some way of creating financial advantage for themselves out of it. Because that is the biggest incentive to innovation, if I can say that, personal financial gain. And so, it'll get a lot murkier before it gets clearer.
Yeah. So I'll just take one last question. And Premal, Arun, I'll reserve the questions that you have asked to some other speaker, because 30 minutes is not good enough for us to be spending time with a personality like Mr. Bhargav. We would have loved to have you for more time. One last question. Between audit committee and risk committee, which has more risk? No.
What do you mean, which has more risk? Phrase your question correctly.
Because many a time directors keep asking, which committee should I join? I say CSR committee, but that's not a fair answer, right? I mean, the least risk committee. But between the risk committee and the audit committee, which one do you think is more riskier in the days to come?
No, there is one answer for the committees, but there's another answer for what committee should I join. You should join the committee where you understand what is going on and you can add the most value. I think there is no ambiguity there. If if CSR doesn't turn you on, you don't get excited about public good. Why would you waste time over that? If you don't understand the risk, if you don't understand the financials, you're not financially qualified or trained, then you will struggle in the audit committee. So which committee to join is a reasonably straightforward sort of determination. Which has more risk? I don't know. I think I would say, audit committee has a broader charter which encompasses the risk committee. Therefore, if you had to pick the two, the BRC is narrower and the audit committee is a bit broader. So clearly it has more responsibility and therefore because of the scope.
Absolutely. Thank you so much. Thank you so much. Pleasure having you. Over to you, Rajiv.
Thank you. Thank you very much, Mr. Bhargav. Thank you very much for such a deliberate question answer session which you have, taken. Thank you very much. And thank you, Jayesh, for such nicely you have coined the thing. Our next speaker is Dr. Ganesh Notrajan. Dr. Notrajan is an executive chairman and founder of 5F World and a platform for digital startups, skills, and social ventures in the country. He is also the founder of Global Talent Track and Skills Alpha and co-founder of 2 Indo-US joint ventures, that is Kalzoom Advisors and the Center for AI and Advanced Analytics. Dr. Notrajan is the chairman of Honeywell Automation India and co-founder and chairman of Lighthouse Communities Foundation, which pioneered the Pune City Connect model of social transformation. He is also on the board of a number of companies like SBI, Hinduja Global Services, Principal Asset Management, Global Talent Track, Educate Girls, and the Asian Venture Philanthropy Network Singapore, and the list continues. He has done his master's in industrial engineering from NITI Mumbai, PhD from IIT Bombay, and AMP from, that is the Advanced Management Program from Harvard Business School. He has been the recipient of Distinguished Alumnus Award from IIT Bombay and NITIE. And he has been recognized by Ernst & Young and the Asia Pacific HR Forum for excellence in technology, entrepreneurship, and people-centric leadership. He has completed 2 successful CEO tenures over 25 years at Aptech and Zenzer Technologies. Also, Harvard Business School has written and is presently teaching 2 case studies on Dr. Ganesh Notrajan and his success through vision communities. Mr. Ganesh has also been chairman of Industry Association NASSCOM and NASSCOM Foundation and other various national committees of Confederation of Indian Industry and All India Management Association. He has also been the president of HPS Club of India and chairman of Social Venture Partners and a member of the SVP International Board. He is a well-acclaimed and sought-after speaker across different forums in Asia and US. for his thought leadership in digital engineering in corporate and social sector. And till date, he has authored 8 books and numerous articles. He lives in Pune. May I request, ladies and gentlemen, to welcome Dr. Ganesh Notrajan. Over to you, sir.
Sure, thank you very much and pleasure to be here. And thank you, Arun and Brigadier, for inviting me to this forum. Also a real pleasure to listen to old friend Akshay, because I think Akshay was again one of the pioneers of the whole business process industry in India. And it's always good to see how many people have built new things and still built organizations which are completely, I wouldn't say risk averse, but aware of their risks and really make everything possible to ensure that there are no lumpiness in the future, to use Akshay's own quote. So let me tell you what I'm going to do in the next 10 minutes. I'll talk to you about digital, because digital, of course, is kind of getting to be a hackneyed phrase, because everybody thinks they know digital. The reality is that very few serious digital success stories exist. I mean, you could point to the 50 plus unicorns we have and say these e-commerce companies, including Byju's, etc., are doing very well. But obviously, as all of us know, the real success of digital will be when traditional brick and mortar companies not only embrace digital, but are able to use it for every opportunity that is possible. I have a presentation here. Brigadier, would you be uploading it, or you want me to?
Ravi, please do the needful.
Yes, sir.
So what I'll do is I will talk about, the way my favorite philosopher Simon Sinek approaches anything. Talk about the why of digital very briefly, what's happening today in the world of digital, and most important, how. How do you get it right? Because I think, as Akshay already mentioned, and we all know, today cybersecurity is a huge issue. Pegasus has taught all of us that what it takes is it's very, very simple to have things on your phone or any equipment. And as Akshay said in the survey that he said, and I'd just like to add that he mentioned 5,000 people, less than 1% respond to email, and probably less than 5% respond to text messages. I would dare say that if you send out a very well-crafted WhatsApp message, you're likely to get a much higher response, because the trends keep changing as you go along. And even today, I don't look at my SMSs or text anymore. Everything is WhatsApp. So I think those are the changes that we are seeing. So if you look at this, this is the presentation. Can you see the next slide, please? Next slide.
Next, yeah.
So if you look at the digital journey of business, as I call it, this is very, very quickly, we all know this. I think if you look at 2020 and 2021, digital collaboration really happened thanks to COVID. It's a cliche to say that, more has happened in 1 year in digital than happened in the last 10 years. But it was purely because social distancing was what enabled digital collaboration to come. But if you look at the past, a lot of the technologies were emerging. From 2014 onwards, people have been talking about moving CapEx to OpEx and saying, how do we experiment with cloud and mobility, access from anywhere, everything as a service, so on and so forth. It's only in 2016 that we started moving away from what I call postmortem analytics. All of us are familiar with getting reams of data, initially on computer stationery and eventually on pretty looking dashboards, which pretty much serve the same purpose, all talking about what went wrong in the past. And I think people are now realizing that the power of data, big data, whatever you call it, and of course, applying artificial intelligence, machine learning to it, is the power of prediction and the power of prescription. Today when Amazon tells you that, look, people like you bought this book, they're both predicting what you might buy and prescribing what you should buy. And sometimes there's a very fine line of ethics and morals between prescribing too early before even you have a chance to make a choice. And that itself is a big risk of analytics and AI almost taking over the cognitive functions that many of us as leaders have enjoyed in our organizations. We've also seen a lot what is today called the journeys, multiple customer journeys, employee journeys, where people can craft out their own method of interacting with the brand, interacting with the company. And I think that's important. And finally, collaboration. Next slide, please. Next slide. Yeah. So if you look at the little busy slide, but what I want to impress upon you is don't get psyched by digital technology. What you see on the top is everything I've mentioned: cloud computing, Internet of Things, mobile technology. BI, AI, augmented reality, virtual reality, or what my friend Satya Nadella of Microsoft calls mixed reality, quantum computing and 5G, which I think was very well articulated by Akshay. But forget about all that. As members of the board of a company, as leaders of any organization, what you really need to look at is the bottom line. And the bottom line, bang in the middle, is enhancing productivity. If you're not getting much better productivity with digital, why are you even implementing this? You're also looking at, if you look at the other slides, improving the experience is extremely important. And today, the reason why we use an Amazon Prime, a Netflix, an Uber, an Ola, or an Airbnb is that you're just getting a much better experience. And finally, the new business models. So what you're seeing here is the new business models. And please understand this carefully, because in your own organization, you will see this move happening. That initially, when your chief digital officer or CIO or CTO brought in digital, it was exactly what Google and Facebook and others did, which is to improve costs. And when you talk about even entities like Alibaba or any others, or Amazon for that matter, you're primarily getting huge value because they are able to really predict and store things much faster, and you're getting the benefits. But I mentioned this earlier. What is happening squarely in our face today is the experience model. And if we're running any organization, and to me, it doesn't matter whether it is a Hindustan Petroleum or a State Bank of India, where I chair the IT and Digital Committee, or for that matter, if it's a large services organization like BPO or IT, providing better customer experiences is extremely critical. I mean, we are currently working on a very large, sophisticated model for getting an organization with 25,000 people to get the people to manage their own learning, not e-learning, which kind of died and got 10% use across the organization, but complete learning where career management, artificial intelligence, predicting how they would learn, what they would learn, is transforming the course completion rates in this thing. That's the experience model. And platforms is where all of us will be. I already mentioned that platforms is what has got Airbnb or even Uber for that matter, because all of them are using platforms to bring provider assets to consumers. So consumers no longer have to buy anything, but they can avail and pay per use and use as a service. So that's the platform model. And we're really seeing a lot of community development happening in platforms. And the reason I'm saying for you, doesn't matter what kind of company you're in, AI and ML will push you towards digital platforms faster than you think. Next slide, please. So essentially, and I won't get into this, I mean, we all talk about AI and digital, and there's also always a fear that, oh, jobs will be lost with automation. Do we really need AI in India, etc.? But it's a conscious choice. One of the reasons why risk management committees must be very cognizant of what IT strategy committees are doing, and audit committees should be able to further add value to that, is that we all have to look at augmentative use of digital technology, the biggest opportunity we have in front of us. Because if it is assistive and augmentative, we don't need to worry about replacing people. It's just going to add so much value that your shareholder value, your customer value, your supply chain value will automatically grow. And what I put on this slide, which you can look at later, is people who are at what stage, like obviously retail, automotive, healthcare, e-commerce are high up there. We are talking digital re-engineering, which was the subject of my last book. And then prior to that is what we used to call digital transformation, which everybody, including healthcare, is experiencing. And even the traditional, very, very brick and mortar kind of organizations like oil and gas, metals and mining, even they are starting to experiment with this. So let me move on now to the beyond the what to, how do we make this happen? Yeah. So essentially, what are we saying? I understand the big five. When I say the big five, I'm saying, how do you really harness digital engineering and digital success? Journeys I mentioned, make sure that you're mapping every current and future journey of every stakeholder of the enterprise. Edge technologies, the traditional cloud, mobility and all is done, been there, done that, everybody has it. But how do you use mixed reality? How do you use audio and video? How do you leverage what's coming in the future, which is quantum and 5G? How do you use Internet of everything? I mean, to integrate right from shop floor to supply chain to retailers to distributors. Data and analytics, I already mentioned, moving towards predictive and prescriptive, and culture. The biggest problem is that today we have 5th generation digital technology. And the risk is that our processes, our business processes will still stay as 3rd generation, which means they're not leveraging the power of digital. And culture or skills or people are still old generation. we still believe comfortably that the digital revolution will not hit us because we are too close to retirement to worry about it. Not true. I mean, all of you and many of you will have careers well into your 70s and 80s, will need to understand the power of digital to feel that you're 24/7 on with the digital economy. Next one, please. So very quickly to talk about the opportunities. I mean, we've already talked about it. Distributed ledgers of blockchains, which is transforming government, finance, etc. AI, as I mentioned, will completely reimagine the future of work. Using virtual and augmented reality, we are even using it today in the social sector, where young slum kids are kind of experiencing what it would mean to be, let's say, a COVID Sathi or a COVID assistant by just getting into augmented reality and imagining themselves in situations like that. And quantum computing and 5G. So I think this is what my friend Paul Doherty of Accenture called the dark economy. But all these also come with their own risks. And let me conclude by talking about the risks and how do you mitigate them. Yes, please. Next slide. So if you look at the risks, I talk about agility. Okay, applications today, nobody wants to wait for a long design and analysis process. So everybody wants to move fast. Infrastructure is on the cloud. It's sometimes shared on Amazon or Google or Microsoft Azure. So obviously that opens up huge chunks of insecurity that you must look at. Cracks in the wall between on-premise and cloud, which is really what I meant, which is that, look, as you move more stuff from hosted inside your organization to the cloud, on one hand, you're very secure because you're probably giving it to a very, very secure data stack provider. But on the other hand, the data doesn't reside with you anymore, which is what I think people are all worried about. Traceability of data, extremely important, because even today, if you're working in the financial sector, RBI and SEBI will insist that there is adequate traceability, that you can't say, I don't know what happened. You have to be able to trace it back. And supervision, as I mentioned earlier, supervision by board, and I think very interesting question on audit committee versus risk committee. I think risk committee has to evaluate every one of these so that there is less work for the audit committee to figure out what went wrong. And I'm a great believer in managing risks and thinking risks extremely carefully. Yes, please. The last slide is really on what I call the how. And if any of you are seriously interested in looking at safe, secure, but futuristic digital technology, I would strongly recommend you look at this kind of 6-point chart. First is understand your starting position. Most people kind of assume that they know what it takes for digital technology. But do the audit of the 5 forces I mentioned. That is the journeys that people are taking, the technology, the processes, the data, and the culture. Then define your strategy, saying that, look, what do we as a board or what do we as a risk committee define as this is the strategy that IT is recommending and we are comfortable with, that is not compromising the security or the data of any one of our partners. Then, of course, and this is, I'm putting technology third because technology is commoditized. You can buy technology very cheap, you can rent it, but don't put technology first and then say, how do I use this cool technology? And that's a problem that many, even CEOs face because they get so enamored by technology. Developing the skills and culture, it's almost like a parallel process because my own PhD research was on knowledge management, exactly the same. That leadership is important, but skills and culture right through the process will make it successful. And then, of course, the word is map, not me, sorry. So it's map, assess, and reassess skills, risks all the time. Because don't forget that new risk, like Pegasus, is a new risk. Cybersecurity, malware, what we talked about in terms of what's happening now, is a new risk. So you have to keep reassessing your risks and make sure that you are one step ahead of the game. You can never be completely secure, but try and let your board and your shareholders sleep better at night by assessing risks. And finally, of course, have very strong measures for managing success. I mean, there's an old cliche that what you cannot measure, you can't manage. And very true. So make sure you have your metrics for digital with as much rigor as you would do for your balance sheet or your P&L items. And once you define the expected returns on digital and then assess the risk of getting those returns, I think the world will be a happier place. Next slide, please. Thank you. So I think this is really what I want to touch upon, saying that, look, we have to re-architect our businesses. Competition will not wait, customers will not wait. We have to make our businesses flexible. So you can't throw security in your customer's face and saying, sorry, you can't do this because we don't believe it's secure. So flexibility and security are probably go hand in hand. And finally, the word I used earlier, re-engineering. You have to re-engineer the processes, the culture to make sure that digital not only succeeds in your organization, but puts you ahead of competition. So thank you very much and happy to answer any questions if you may have.
Thank you very much, sir, with your kind words of wisdom, sir. And I invite JS for the brief question answer session, please.
You're on mute, sir.
I said thank you very much, sir, with your kind words.
So I think Mr. JS was on mute.
Achha, JS was on mute. Okay.
Yeah. So I'll take from where Akshay had left, saying that banks may become extinct. Now, sitting on SBI board, what do you think your risk management committee would discuss? What is the worst that can happen? 3 agenda points, please.
I think the gentleman who got me onto this session, who chairs the risk management committee of SBI, could probably answer that better. But okay, I will try and do it on his behalf. No, I think you're looking at a gamut of risks. I mean, I talked about only digital risks, and I think all of us are aware that today there is, right from currency risk, your exposures, the risk of, as I said, overexposing information to people who should not have it. I think there's a whole. I mean, I can, and I think even I'm also on the risk committee of places like Honeywell and Hinduja. I mean, there is just so much that hitting us from different points, from sides. I mean, both external and internal in the organization. So I think you really have to, I think our risk committee in State Bank meets very, very often. It's always a very, very productive agenda. And it's always something new that's coming. So financial services sector is absolutely right. But that's what I said earlier. I mean, even whether it's financial services or healthcare or even manufacturing, I think risk committees will define the future of the organization.
Yeah. So, okay, while on that, do you need any qualities or qualifications to be part of the risk management committee, or it's just the wisdom?
I think all of us have tried to wing it in the past with wisdom, but I think you need qualifications, yes, because I really think you need, first of all, I think, as I still remember when I went to Harvard Business School, I was already CEO of Aptech. And then I joined Zensar, and it was our group policy to go for the 10-week AMP. And like many of us were like very seasoned. And we went into a 10-day accounting boot camp. And we were all saying, my God, we're running companies and these guys want us to learn accounting. And our professor was Shrikant Datar, who was now is the dean of Harvard Business School. So Shrikant said, guys, if you think you know finance, in 10 days, you will know how bad you are. So the answer to your question is, you need a very strong orientation to numbers. Okay? And I don't think people on the risk committee can get away by saying, oh, let that be done by audit committee or somebody else. So I think understanding the numbers, the implication of actions on numbers, I think is a prerequisite. But beyond that, of course, is a much wider understanding of what are the customer risks, the supply chain risks, the employee risk, and everything else.
That's great. So Revati and Premal, I think both of them have a sort of similar question, which is, boards are normally ill-equipped to understand digital tools and other solutions. How should boards prepare themselves to look at digital strategies? Any hierarchy of digital journey you propose?
It's a very interesting question, Revati, because I actually did a workshop 6 months back for the independent directors of various boards. And I think it starts with your wanting to know. I mean, if you look at my own background, I'm a mechanical engineer, industrial engineer. But having got very interested in digital, not so much in the technology, but in the ramifications of the technology, if you will. I mean, I really find myself drawn into this. And I think it's not difficult to understand what I talked about in terms of re-engineering. So if there is an interest, I would strongly recommend that every board director must learn adequately about digital. Because ultimately, as I mentioned earlier, every business is going to be either riding on digital or be dependent on digital platforms, which are multi-user, multi-company. So if you don't get it, somewhere you will feel out of your depth. And I would strongly suggest that everybody should go through not necessarily a primer, look at your areas of interest, either functional or business domain-wise. And there's enough reading material and I think enough content available to be able to educate yourself on it. And I think IOD should probably start some workshops on specific.
I know, that's a very good point, actually. I think point taken. Arun Kumar is asking a question. In banking industry, risk management functions are driven by Basel norms. Do you have any similar standards in other industries?
I honestly wouldn't know, so I don't want to guess. But yeah, I mean, obviously the Basel norms are very well documented. But I mean, there is no specific, because there's very little of the kind of regulation that you're finding in the banking and financial services in other industry. I mean, the insurance to a large extent there is. But Others like manufacturing, healthcare, again, there's a lot of regulation coming through. But not, so there are enough norms. Do the norms directly impact digital? May not be, but there will be norms that are looking at every industry. And I'm sure all of you in your respective industry segments will know what is the compliance that you have to adopt.
Yeah, I understand. There are, I think, in the participants, people representing education institutions. Now, since you have this AppTech as the background, which was into training now, what do you think, is the risk for brick and mortar education institution and e-commerce like Byju's? If you can separate these two and then tell us what's the risk that we are actually looking at?
It's a very interesting question, and I wish I had a half an hour to answer this question.
I know.
I was very actively involved in Harvard Business School's HBX model. And there again, it's a very classic example of, see, a lot of unfortunately, our educational institutions in India tend to believe, we'll subscribe to some Skillsoft courses, etc. And we've done it. Digital is over as far as vacancy. The fact of the matter is, which I kind of said almost rudely, is that e-learning is becoming a mess because hardly 10% of people complete courses. So in a situation like that, where people won't automatically go and drink from e-learning courses, you can't keep digital on one side and say, okay, my traditional classroom will do it. So the HBX model was where we could actually use artificial intelligence and say, if Michael Porter is teaching an 80-member screen, not 80-member classroom, right? How does AI help Professor Porter to say the person in screen number 17 seems to be dozing off? Question. Or how does AI help, or in an assistive augmentative mode, to enable the pedagogy and enable the professor to be more complete? So I think you'll have to integrate the models. It's not what Byju's can do vis-a-vis, let's say, what Pune University can do. It's how can a Pune University become a Byju's, and how can a Byju's have the brick and mortar and the networking capability of this. I'm actually working with a Argentinian client at this point of time. We're just saying that, look, and I think, again, what Akshay mentioned earlier, that the whole work from home is honestly a mess, in my opinion. Nobody will admit it. Okay, everybody's, it's perfect. We've got cost reduction, savings. But isolation issues, psychological issues must hopefully drive people back into offices, not full time, but at least part of the time. And as boards, I think you have to ask these tough questions. The minute I say that, then you will find that the integration issues of young people who have joined, who get a mentor at work, etc., all that needs to be done. So how do you, as far as possible, in the Argentinian company, we are saying, how do we ensure that even through technology, we're able to simulate the chance meeting at the coffee machine, the interesting chat you have with somebody over dinner, and we're kind of simulating those experiences. But I'm saying the best way is to ensure that physical and digital come together. I mean, what Chandra of Tata Sons has written in terms of digital. So digital economies or phygital, as whichever word you want to use, this blend will have to be there. You can't be one or the other. It has to be both.
Okay. Jyotsna, after speaking with Ganesh, of course, I'm using some natural intelligence here and keeping your question for some other speaker. Just hold on. And to conclude, one last question from Bhaskar, Ganesh, which is ERP, RPA in the environment of digital technologies. How far are these advanced technologies market fit, affordable, financial viability, rather than being good or great at R&D?
Let me assure you that everything is affordable. What you cannot afford is to put in an RPA into a cultural situation which is not ready for RPA. That is where the mess comes. So the technology itself is inherently very cheap. And today everything is literally, as I said, pay-per-use, so don't worry about it. But ensure that when you throw the seed, the fertilization or the bed on which you're throwing the seed will enable it to flower. Otherwise, it's just a waste. And just one last, I can't help responding your AI thing. So don't forget that artificial intelligence can never overcome normal or human stupidity. So don't throw artificial intelligence when you don't know what you want. Okay, that is the worst thing you can do in digital. That's why I'm saying culture skills has to be embedded in everything that you do. Thank you.
Thank you so much, Ganesh. Over to you, Rajiv.
Thank you very much, sir, for such an informative talk, sir. Really honored, sir, to hear such wise views from your end, sir. Ladies and gentlemen, before we move on to the next speaker, I would just like to reiterate the chat box is always open and Mr. Sundareshan shall be taking all the questions. Do listen to the eminent personalities and speakers and keep posting your questions. Moving to the next speaker is Mr. Bhargav Das Gupta. Mr. Bhargav Das Gupta is the MD and CEO of ISI Lombard General Insurance Company Limited. Since he took over the role in 2009, under the leadership, the company has strengthened its position as the country's largest private non-life insurance firm, consistently delivering long-term value to its stakeholders. ICICI is also the first non-life insurer to be listed as the Stock Exchange of India. Mr. Bhargav's philosophy of customer centricity has enabled the conference to introduce several best-in-class risk management solutions backed by the latest technology platform to meet the risk mitigation needs of his customers. Mr. Bhargav began his career with the erstwhile ICICI Limited in 1992 and has held critical leadership positions in diverse business areas in the ICICI Group, including project finance, corporate banking and treasury, e-commerce, strategy, international banking, and life insurance. Some of his key roles include as co-ICICI Econets Limited, where he was responsible for private equity investment in the internet communication and technology sector, incubation of new internet-related businesses, and e-initiatives of the various business unit of the ICICI Group. He has also set up the international banking group of ICICI Bank and built his presence in the 15 countries in just 4 years. The international business strategy became a case study at Harvard Business School. Prior to the current role at ICICI Lombard, he was the executive director of ICICI Prudential Life Insurance from October 2006 to May 2009. Mr. Gupta holds a PGD BA from the IIM Bangalore and a BE Mechanical degree from Jadavpur University. Currently, he is the chairman of the FICCI Insurance and Pension Committee and is a director on the board of BFSI Sector Skill Council of India. He is also a member of the IRDAI's Insurance Advisory Committee. Without wasting much time, over to you, Mr. Das Gupta, please.
Thank you, Rajiv. Thank you, Arun, for inviting me. It's honestly a privilege to be here talking to all of you. I've been asked to talk about assessing risk in insurance, but the way I've kind of structured the presentation is to talk about what we believe can be a help and support that insurance industry can provide to risk committees and organizations in general. I thought that would be probably a bit more relevant for all of you here. So I've got a presentation. How are we going to do that? Are you going to upload it or do you want me to share screen?
We have already uploaded, sir, and okay. There it is.
Yeah. Okay. So if you can go to the next slide. Yeah, thanks. So, whenever we have a seminar like this, when we're talking about risk, personally, I believe we at times we swing to the other extreme and think of everything that goes wrong or can go wrong. I want to start with a different note. I think if you look at a broad swathe of history over, let's say, the last 120 years, actually, we've won quite a few battles. And overall, if you look at the traditional risks that we've lived with over the years, actually has come down. The world is actually a much better place today. If you just look at the number of deaths, lives lost at a world level due to some of these natural disasters, the number used to be on an average per year, using a decadal average, was more than 9 lakh lives lost, about 100 years back. That number last decade was 72,000. And if you look at, diseases that we won, the fact that we don't have famines, we don't have droughts, clearly civilization has actually progressed in a positive direction. So what are we worrying about? Can we go to the next slide? One of the challenges that we have, we all understand our own biases. There is, the tendency that we have as human beings to look at the rearview mirror to decide what is going to come and hit us in future. We also have recency bias. So we look at some of these, risks that used to be a big problem in the past and only focus on some of these things without realizing that the risks are changing and morphing. I think someone asked a question that how many risk committees or how many companies predicted the COVID. The answer would probably be, 0. And that's really a problem. there's also recency bias. So one of the things that you've seen reports from World Economic Forum or many firms who do a survey of risk managers across the world and ask them what is the number one risk that you worry about. Terrorism was the number one risk in 2002 after 9/11 happened, but not in 2000. Global economy in the risk of global macro economy was number one risk in 2009, not in 2007. Similarly, pandemic was not a risk that everyone worried about in 2018, but today that would be number one risk for us. And that actually tells us that as risk committees, we really need to think about risk a bit differently. Our view is that risk, and we are in the risk business in insurance, our view is risk is a board agenda, risk is a strategic agenda, risk is a CEO agenda, not just a CRO agenda. Next slide, please. I think, Mr. Bhargav and Dr. Notrajan both talked a lot about some of these, issues on the technology side. But it's not just about the new risks that are coming in technology. This is something that all of us talk a lot about. The question is, how well are we prepared for it? If you look at other sectors, so for example, genomics, etc., is going to, help a lot in terms of eliminating cancer potential, or in increasing longevity. But it also leads to gene editing and gain of function research that that we've seen could lead to a new virus mutant that leads to a pandemic that we're going through. So some of these innovations are good for people in the long term, but can bring in new risks. And question is, how are we preparing for some of these risks? Next slide, please. Again, one of the topics that got discussed in Q&A session was how well are organizations prepared. And one of the questions that I saw was someone asking a question whether people even have risk management committees. Being from the BFSI sector, our experience is that risk management has been a absolutely key constituent of our board management practices. Most regulatory businesses have them. Financial services definitely, insurance definitely. We, as a company, have had our enterprise risk management module, very early in our existence. Around 2007-8, we set it up, and we've seen it evolve over years in terms of giving us a lot of tools to monitor risk as an organization. Having said that, so it's a good tool, and the challenge that I see is that a lot of companies don't even use a tool like ERM, which, in our opinion, is a must for any organization. But one of the challenges that we've seen in a ERM tool is that it's an absolute indicator of where you are. I mean, you can create dashboards, you can create, risk, appetite scores. You can look at monitoring where you are against risk appetite scores. You can quantify the risk numbers and look at it for yourself. What you can't do is benchmark yourself with the rest of the industry. Where do you stand compared to your competitors in your risk management approach? And our view is that's something that we really need to build as companies together, so that each one of us are able to benchmark ourselves vis-a-vis the other competitors in the industry. Next slide, please. So one of the things that we've kind of worked on, and this is an approach that we've taken, is to see if we can devise a measurement tool, a scientific risk management tool that breaks down the risks into various elements and quantify them for actionable agenda, which the board can supervise and oversee. And if you go to the next slide. So when we looked at this tool, this is a tool that we built along with Frost & Sullivan as our knowledge partner. We've looked at a corporate risk index for India, and we've looked at 15 different industry verticals, designed a risk management risk index for each one of them. The approach that we've taken is that it's a twofold approach. One is when you look at risk, it is not just the fact that you have to quantify, first be aware and identify, and then quantify the risk. But you also have to look at what is your approach to managing that risk. It's not just good enough to say that, okay, this is the risk that we are identifying. What are you doing as an organization to manage some of those exposures? And we've seen very different approaches across the industry. And the second key motivation was that, can we convert all of this work that people are doing into a measurable score, which is a kind of a number output which people easily can identify with. So it's like saying that you can assess credit risk, but until you put a framework of a AAA versus a D, you found it very difficult to identify who's where. So once you see a credit rating of AAA, you know that this is a top-notch company where risk of default is very, very low. There is nothing similar for risk. So the whole approach that we took was, can we do something similar for risk management? And when we looked at the dimensions of risk, they're largely kind of grouped into 6. One is the market and economy. Geopolitical risk. I don't know how many boards think about these issues. I'll give you an example that we saw in insurance, largely driven by the fact that most supply chains are totally interconnected today. 2011, there was a huge flood in Thailand. Now, Thailand was, and still is, one of the biggest producer of auto components. One of the things that we never anticipated, but we saw, was production shortage, production cuts in India. We are seeing the same thing with the semiconductor industry. And if there is a geopolitical risk of, let's say, a war between China and Taiwan, what will happen to your business? What is your dependency on some of these semiconductor supply? So these are some of the things that, most times people don't think about, worry about, because these are not, as one of the speakers said, it's not something that you're expecting every other day. Technology, I think there's been enough talk. I don't want to spend more time, but the risk of disruption is real. If you don't disrupt yourself, someone else will disrupt you. Crime and security. I mean, cyber crime is something that everyone's talked about today. Just the question that, this is something that we know, we see, we are aware of. We also know that this is a risk that is changing every single day. Technology is evolving, and the criminals are also changing, their tactics along with that. There are, nation states which are fighting this war in a sense. The question is, are we prepared in any way? I mean, obviously it's like earthquake. You cannot really predict whether it'll hit you tomorrow, but how are you preparing for an eventuality that you get hit? Do you even have a agreed principle for crisis management? Do you have an agreed policy for paying ransoms when you're stuck, or do you kind of grapple with it at that point in time? I think operational physical risk is something that most organizations are relatively better prepared. Comes from the manufacturing mindset of factory safety. But again, we see tremendous variation across companies within the industry, where people are significantly, range from being significantly safety conscious to, people who are very, very lax. Natural hazard and events we talked about. But again, let's understand, I mean, this is something that there's been a lot of, press on the IPCC report on the impact of climate change. If you've seen some of the losses that we saw on the Tokte cyclone very recently, the intensity of the cyclone was very different from what we've seen in the West Coast. East Coast of India has always had very, very severe storms. The West Coast, and by the way, most of the factories and the buildings around the coast in Paradip, etc., are built to resist wind speeds of 130, 140. The West Coast is not so, because people are not used to the speeds of or wind speed of that intensity. But we are seeing changes. We are reading the reports that IPCC is presented. We are reading the fact, seeing the fact that there is warming in the Arabian Sea, and we will see more intense rainfall. Are we preparing for it? So not only what we've seen in the past, but there is changes happening because of the climate change. Are we preparing for it? Next slide, please. I mean, I won't go into the other risks, but there are many risks. Again, I've touched upon this. I think managing these new age risks needs a lot of scenario planning at a board level. It is probably almost like your strategic business plan. You really need to think about a strategic risk plan. And one of the learnings from this pandemic is that in the past we were optimizing on efficiency. But if you keep on optimizing on your efficiency, in an event like this, you run into serious risk. And managing or building resilience is an important element. And that is so true in cyber risk. Building resilience and planning for a remedial action when something happens to you, because there is a high risk. I think Mr. Bhargav talked about the fact that so many companies in India are getting hit. There's a high risk that each one of us will be vulnerable one day or the other. Next slide, please. So what can insurance do? I think insurance plays two roles. I mean, the traditional role that insurance has played is transfer of risk. You give us a premium, God forbid if something happens, we pay the claim and, in a sense, share the burden. Increasingly, there is other, other roles that insurance is playing. One is the development of matrices to measure risk. I talked about the corporate risk index. As I said, we've done this for 15 industries, and we've got a score. It ranges in a 5-point score from inadequate to suboptimal, optimal, superior, and over-invested in risk management. You also don't want to over-invest in risk management. It's a bit of a waste of money. So it's a 5-point range. India, today is at an optimal level, which means we are kind of optimizing on the risk, and something goes wrong, we run the risk of reduced resilience. The other role that insurance is beginning to play is in building capability on risk mitigation and prevention. And in the next slide, if you can go to the next slide, these are some of the things that are happening. As I said, insurance industry is no longer, at least from within ourselves at ICICI Lombard, some of the work that we've done is to mitigate and prevent risk. So, for example, when you look at your marine transit losses, if you analyze the claim and you see that there is a higher incidence of claims in a certain route, you can, analyze and figure out why that problem is happening. And today, with let's say telematics and tracking of cargoes across open sea, you can actually prevent some of these, maybe a hijacking that can happen. You can prevent, water ingress because you can track the moisture, ingress into your cargo. You can even have a mechanism which measures temperature. So if you have got a refrigerated cargo, we've seen this happen in India, right? So the driver will optimize on usage of diesel and keep the air conditioning off for some time. So our devices gives a trigger. The control center that we have in Pune calls up the driver and tells him, what are you doing? So this actually is a win-win for us because we try to reduce the claim, and for the client, it also helps in terms of better confidence about their entire supply chain. Similarly, on property, all of us, all factories we see have a nice, freshly painted, bright red hydrant system. No one knows what is the water pressure inside. Today, again, with sensors, with the IoTs, you can actually monitor them. We have that solution, which we rolled out to quite a few of our customers. And similarly, there are sensors for other risks that you see, which lead to fire and other losses. And similarly, in health, I'm sure all of you seen a lot of this. One of the pilots that we did using our CSR fund was in the district of Puri, where we used CSR fund to pay for OPD claims. And we actually saw, this is for a social insurance scheme, government scheme, where only the IPD was covered. But the moment we paid for OPD claims, we saw IPD claims come down. Now, the theory behind this is pretty clear. If you treat diseases early, the severity of claims come down. And again, these are solutions that are something that insurance industry is working on. With that, that's the last slide that I had. Again, thank you, and open for any questions.
Thank you very much, sir. Over to you, Jayesh, please, for the question answer session. Jayesh, can you hear me?
Yeah, very much. Thanks. Let me start with a very simple question, which has been asked by Lakshmikant after every session, which has been, what are the financial loss if cyber security happens? And if disruption of digital risk happens, what is the financial loss? Now, can you help assess, and what will you pay in case of such losses?
Yeah, so there are multiple losses. It's not financial, reputational, and there could be policy structure for that. The ransomware is a straight quantification. It's not very difficult to quantify that. So you know how much you're paying. If your policy covers that, that would be paid. What happens with the cyber policies is that you actually step in and help in terms of the negotiation. There are expert firms globally who step in and help you with the negotiation. So not only do you pay for it, but you kind of get an expert support to deal with it. Similarly, there will be other losses in terms of maybe your servers, your equipment, which can be quantified, and you'd settle for it. One of the challenges that we see from an insurance industry perspective is that there are two levels of this issue. One is that corporates still now, in spite of the reality of cyber threat that we are talking about, still don't buy proper cyber covers. I mean, they kind of optimize on the cost and hence buy very, very minimalistic cover. The second challenge, which is from our industry perspective, is this is an unknown risk even for us. How do you risk your balance sheet and take very large exposures? So what we do as an insurer is that we protect ourselves through reinsurance. But the global reinsurance market for cyber is also developing and emerging, because this is a new threat that we don't have models for. So it's a journey, but there are enough capacity available for the Indian market today to protect a reasonable amount of cyber risk.
You just said risk is unknown to us. I mean, you cannot say that. I mean, we can say that. You cannot say. No, I'm just saying. So in that case, how often do you assess the risk of your customers?
So the principle that insurance companies do, you see us as taking premium, paying a claim, but a role that underlying the role that insurance companies pay is allocating, or in a sense, allocating capital towards better risk. So if you do a better risk management job, we will give you higher covers, or we will reduce your premium, and vice versa. In effect, it kind of directs capital towards companies which are better risk managed, right? That's the underlying role of insurance. Now, when you quantify risk, so one of the things that we do is we do our own. We have our risk engineers who go and understand the protocols and the safety standards that you have for your physical risk, let's say your factories, etc. Similarly for cyber, it's again very early days. We are evolving some of these capabilities. So at least what ICICI Lombard, what we do is we work with a couple of technology partners who are kind of experts in this area, and we do our own with them. We do an assessment. The challenge that we face is a lot of times customers are very guarded about some of these, because it is seen as maybe an intellectual property or whatever it is, so they're a bit guarded. But of course, the assessment is important for us to quantify the exposure that we are willing to take. That's our underwriting practice.
Now, with this COVID happening, post-pandemic, what do you see? The question from Premal is, do you see improved life expectancy? And if yes, does it pose a risk for insurance industry?
Look, life expectancy, if you look at, again, I talked about the 100-year data, 100 years back, it was in the 30s. We are today, 72. I'm not talking about just India, I'm seeing a global average. That number was 60s even, 30 years back. So life expectancy is increasing, and we believe it will keep on increasing. And increasing the risk from a life insurance industry is different from, from our industry, because we are paying for medical costs, whether you live or survive or unfortunately don't, we still pay for it. The life insurance industry has a different dynamic in terms of people live longer. Then the risk for some of the pension plans get increased, but the mortality risk comes down.
Okay. There is a question from Om Prakash, which is how and where to capture long-term risk that may affect business, like decarbonization affecting refining business and so on.
I think, both Dr. Notrajan and Mr. Bhargav both kind of commented upon it, that the risk management committee is a vital part of, an organization, right? And I was listening to the debate about whether audit or risk. My view is that risk has another role, which at times gets missed in audit. And that is evaluation of strategic risk. Audit at times focuses on the here and now, but some of these long-term impact of maybe technology change, in this case, let's say climate, or the pressures that ESG funds are putting on your core businesses. These are strategic risks, and there needs to be a place where you have those discussions. It may not lead to any immediate impact on your quarterly numbers, but unless you take some actions over the maybe 5 or 7 years, you will be at risk. And I really like that slide, that pie diagram, Venn diagram that Mr. Bhargav put up. I think it's very, very true, and that's a job that risk management committee should do.
Yeah. Then there's a question on what do you see the risk on working from home and office in organizations in coming years?
So again, Ganesh talked about some of the cultural aspects, and that's very real. From a pure tactical perspective, you also have a challenge that, as an organization, when people are coming into our office and working, we had to focus on the perimeter security, right? We have firewalls, people are coming inside it. We ensure that, the threat of someone breaking that, breaching that firewall was low. Now you have to think about the endpoint security, because there's no firewall in everyone's home. So every device, and a lot of companies are experimenting with BYOD, etc. Every device has to be protected. So the endpoint security becomes very important from the cyber risk that we talked about. I think the larger issue is the cultural aspect. I think there are some big advantages, but how do we address some of the negatives that rightly have been articulated? So how do you find a way to create a hybrid model, if you can? And you have to see whether the hybrid model works. In time, we'll know. But create a hybrid model where some of those engagement, the connect, the bonding, the things that happen, collaboration that happens when you come together in one place is protected, while day-to-day work can be done remotely. So can you move into a more of a hybrid organization rather than either remote or either on-site?
The next question is, of course, how often does the risk management committee invite you inside their meeting to discuss one-on-one?
So, for example, we in ICICI Lombard, we have a practice where the board has independent directors of the board separately discusses whatever they want to discuss that is relevant, that they believe. Post the discussion, they call me in. We have a discussion on some of the items. Now, I'm personally a member of the risk management committee. I'm not a member of the audit committee, because audit, as I said, is a slightly different charter than the risk management committee. So in the risk management committee, there is a lot of deliberation about some of these risks. We every quarter prepare a risk report using the ERM framework, and every risk we've found a way to quantify, create a dashboard. It works for us. Every company should create whatever works for them, and we present it to the board. And there is a lot of deliberation on the dashboard, as also some strategic risks that we talked about.
Add on to that, how many top 1,000 listed companies invite ICICI Lombard inside their boardroom to make a presentation?
Very, very few, and some do. But you're absolutely right. I think that's a point that I've made many times whenever we've talked about risk. Unfortunately, in India, I think we spend a lot of time on the business planning. We hardly do any work on risk plan.
Exactly.
And I personally believe risk is a strategic agenda, as I said earlier, of the board, and we should see more of that.
I think
insurance is not something that you can delegate down to an insurance person or a broker and assume that everything will be taken care of.
Absolutely. That's the point I'm trying to make, because most of the time the consultant deals with the policy and not the ICICI Lombard directly with the risk management committee. That should change. And for many of those who are not inviting you means companies like you, I think they should start inviting you.
Exactly. It's not us. It could be a quality advisor. No problem with that. But even that, if it's a broker, insurance broker, or an advisor, there should be a proper dialogue with the risk management. It's a once in a year agenda. You don't have to keep doing it every year, every quarter. But it's important.
Before we part, how to read exclusions?
The point that we keep making as an industry, at least as a company, is at least please read. The real problem that we have, and this is a communication that I make to my sales guys, is it is very important for us to transparently tell you that these are the exclusions, and it's equally responsibility of the insurance buyer to study what is the exclusions. Don't buy a mobile thinking you bought a Mercedes. Both are transport devices, but they're different. Unfortunately, the discussion is largely on price and not on terms. And that's the reality of, but I'm optimistic, because I think people are beginning to understand and appreciate some of these things, and we will evolve. I mean, in a sense, this is kind of early days for the industry.
Is COVID an act of God? No, I'll close with that.
That's a big debate. Someone will say, there's a big debate on laboratory created. I talked about the gain of function, research, right? So who knows what is the truth?
Thank you so much. Over to you, Rajeev.
Thank you so much.
Thank you very much, sir. Thank you very much. Great. And before we move on to the next speaker, he's Mr. Menon, whom every one of us know. He's the managing director at Thomas Cook India Limited. Mr. Madhavan is an experienced managing director with a demonstrated history of working in financial services, leisure, travel and tourism industry, a strong business development professional with special skills in negotiations, business planning, operational management, risk management, and business development. Mr. Menon is an Indian business person who has been the head of 5 different companies. That is the chairman and MD at Thomas Cook India Limited, chairman at Thomas Cook Tours Limited, chairman of Indian Horizon Travels and Tours Limited, and Mr. Menon is also the chairman at Fairfax India Charitable Foundation. Plus, he's also on the board of 22 other companies. In the past, Mr. Menon held the position of chairman at CSB Bank Limited, chief operating officer at Citibank and ANZ Grindlays Bank Limited. Mr. Menon received his MBA from the GW School of Business and undergraduate degree from American University of Beirut. May I now call upon Mr. Menon? Over to you, sir.
Good evening. I want to first thank the Institute of Directors for having me on this webinar. I also want to thank Arun Balakrishnan, Brigadier Kapoor, and of course, thank Bhargav for recommending me to appear on this thing. But, you know, on second thoughts, after seeing Mr. Bhargav, Mr. Notrajan, and then Mr. Dasgupta, I'm not even sure I should be here because what I have is an intensely boring subject of making all of you travel and trying to identify the risk around your travel. But anyway, let me take a shot at it and let's see how it works. First of all, I think just to put everything in context, the travel and tourism industry and to a large extent the hospitality industry are bundlers of services. We procure services from B2B partners and then package them and bundle and package them and sell them on to consumers. I very often tell my colleagues, we are actually the jam or the butter between 2 slices of bread. On one side, the vendors or our B2B partners, and on the other side, the consumer. And, you know, therefore, for us, risk comes from all ends. And very often, the risk that we're talking about is totally beyond our control. And we just need to try and anticipate it. In terms of the sources of the services that we buy from are essentially airlines, hotels, surface transport, restaurants, and tourist sites. In terms of the customers, we deal with retail customers, we deal with corporate customers, we deal with agents and franchisees, and increasingly, we're beginning to see that a lot of our business, especially in the post-COVID environment, has produced a new customer, which I call the digital customer. In terms of, let me just spend just a moment on this slide, basically trying to identify the typical internal risks that we have. If you can change the slide, please.
Hit on next, please. Yeah.
Yeah. So typical internal risks are human resource risks relate, for examples of fraud, attrition, data confidentiality, products and services, obviously quality versus expectation. One of the speakers, in fact, I think it was Bhargav who talked about this focus on price. Trust me, I live every single minute of the day trying to explain where price is not, the lowest price is not necessarily the best quality that you get, but the reality is that's the way where we live, the world we live in. Business concentration, essentially over dependence on either a business, a segment, or a customer. Credit risk, supplier, vendor, and outsourcing partners, service quality, technology, process and controls. I won't go through all of those items, but let me just sort of go to the next slide, which are the external risks. Now, the point I want to make here is that given being a bundler of services, our external risks and our internal risks are very clearly aligned. And for a company, for Thomas Cook, we've had a risk committee for over 20 years now. And now it has reported directly into the audit committee all these years. But with the new regulation, the risk management, this committee will now report into the risk management committee. Essentially, the external risks have been enumerated, and I'm not going to spend any time on this page because it's all generic. Can we change the slide, please? But I want to sort of spend a little time on this page, essentially talking about the risks associated with the travel and tourism sector and the hospitality sector. Currently, we face all the risks that every other sector faces. However, the impact of these risks are far greater, are different than any of the other sectors. Invariably, we are the first to get hit, and very often we are the last to come out. And COVID is a typical example of that. March 24th, 2020, we saw our revenues ground to zero. I actually very often define it as I went from being a hero to a zero in exactly 12 hours. And we are very susceptible to these risks, and therefore the volatility that we face as an industry is fairly significant. The key risks for the hospitality, travel, and tourism sectors are essentially the impact of the pandemic. I don't think I need to spend any time talking about what the impact has been. But if we start addressing what are the potential risks that are going to emerge out of this, I think every day when you either wake up and look at the news or look at all these forwards that keep coming at you, you realize that the world has completely changed. Can I send passengers who are vaccinated? Yes, we can. Can I send a passenger who's got a Covishield, completely been vaccinated with Covishield vaccine as against Covaxin? Answer: we don't know, because some countries don't recognize the biotech vaccine. I suddenly heard the other day that there is a country in Europe which doesn't even recognize the Covishield vaccine, even though the fact that it recognizes other AstraZeneca products. Health screening, quarantine and testing, social distancing. Every time we send a tourist now out of the country, the risks are significant. Significant as in, can I ensure that the anxiety of a customer is fully addressed from services that are not even controlled by me? That's a significant risk. A second risk, which has been addressed by every speaker this afternoon, is cybersecurity. And the impact on the travel industry is significant because we are very vulnerable to data breaches, primarily because we are as an industry are manpower intensive, and the staff or the employees have access to abundance of customer data, in terms of what they're buying, what their banking details are, all sorts of things. So I think this is an area which we have identified as being of serious risk. A third one is technology obsolescence. These sectors, service people need to adapt to changing technologies, such as facial recognition, virtual, augmented reality, AI. There are all sorts of things coming out there. And, being a service provider who bundles services, we are forced to match the innovation that's brought out by our service providers, as well as match what the competition is doing, or even in other industries, because that's what our customers have come to expect. Severity of natural disasters. I mean, Bhargav talked about the natural disasters. Unfortunately, the impact on us is slightly different. Flight cancellations, delays, loss of tour days. I mean, a variety of risks that are difficult to anticipate. But once we are aware of something, we've got to go through this whole exercise of making sure that we've addressed all these risks on every single tour that we send, either a group of people or individuals. Global political uncertainty. Now, this covers terrorism, political disturbances, enhanced social unrest. A classic example, if I can give it to you, is we have during a normal summer, and I use the word normal because up to 2019, it was a normal summer. We haven't seen, this is the second summer where we've seen a normal situation. A coach that was going through a European city suddenly gets delayed by several hours because there is a demonstration that's blocking the road somewhere. Now, the customer who's sitting on the coach doesn't really understand why the coach is getting delayed, because it's traversing one city to the other, and they get delayed, and this results in all sorts of claims and complaints and a variety of things. So, political uncertainty in any form, be it a local demonstration, be it two countries closing their borders to each other, can be a major problem. Financial resilience is currently the one in context. Pre-COVID, we are an industry that is negative working capital. We've never had to worry about liquidity, because we managed both the services that we bought from somebody, gaining credit against it, as well as giving it to the customer and ensuring that we balanced our working capital. Unfortunately, 18 months has resulted in a major disruption. And this is another major risk. Can you change the slide, please? I think other areas that we need to seriously consider is consumer anxiety. As I mentioned earlier, a consumer today is very wary of how he will get infected. It starts from when he walks into the airport, into an aircraft, arrives at an airport, goes into a coach or a van or a car, lands up sightseeing, and then wants to socially distance. When he goes out to eat, does he, is he adequately socially distanced? Now, how do we manage these risks? I think that this is a new form of risk that we are having to address, and constantly looking at all our service providers and trying to understand how they manage their risk. Using technology to build customer confidence. I think a result of COVID has been that every customer, and I think Dr. Notrajan talked about the digital customer. I think it's important to recognize that we need to look at the world as this digital-only customer who expects you to live by those standards, but at the same time choose how they will interact with you. Today, we have customers who come online, want to buy something, and then suddenly switch into a phone call, and possibly some of them even want to visit our offices. So we're beginning to see different methods that we need to interact with the customer and ensure that we're able to deal with it. Third factor is the human factor. Despite what everybody says, the reality is travel is a intangible at the beginning of the journey. A lot of people don't know what to anticipate. The average Indian traveler is a very insecure traveler. Now, how do we manage the risk around, a group of people going together, potentially an accident, various factors? So, there is an element around that. Effective communication is what I call, ensuring that you're able to communicate right down from your employees to your customers and everybody else to ensure that they understand exactly what we are trying to do. Top-down approach of holistic evaluation. Very often I find that people believe that ours is an industry where we can direct people to do whatever it is. But reality is execution sits on the front line, unlike a lot of other industries. In the service industry, this is a common factor, but the reality is, how do we deal with that situation? Another key area that needs to be considered is detection of hazards, identification of stakeholders, and risk owners. Assessment of the level of risk appetite, and connected to risk to strategy, embed risk management in business processes, and a subjective and objective evaluation of risks. Now, the reality is that we need to address each of these issues. And most of these are things that we've always taken for granted. And today, suddenly, because of the change that we've witnessed in this world, maybe over the last 15 months, there's suddenly risks that are being evaluated because we are not confident that we can cover or we have an understanding of each and every risk. Can you change the page, please? Key pointers that I want to leave is most organizations follow a top-down approach, which I mentioned earlier. However, implementation in our industry is at the grassroots level. Detecting hazards, creating what we have done is for each business, we've created a risk register. The department then identifies key risks, mitigants. Those are then created into a dashboard and monitored. We identify stakeholders in every single business of ours and then try to identify what are the risks associated with each of them. Increasingly, external risks are being prioritized over internal risks. And this is a factor. I think, as I mentioned earlier, COVID has thrown up a whole lot of new risks, which were never anticipated earlier. We believed these were risks that we could manage, but suddenly we're sitting on risks which are maybe outside our control and therefore need to be mitigated to the best possible. Assessment of the level of risk appetite. And this needs to be connected to business strategy because we deal with customers, retail customers. We need to ensure that, we need to understand what appetite they have for risk, because going from one country to another, very often some countries may have certain problems which we're totally unaware of in terms of where we are. For example, somewhere in Europe, there may be a demonstration, there may be a roadblock, we're not even aware of it. So the reality is, that risk appetite needs to be evaluated on an ongoing basis. Evaluation of risk is also based on the likelihood of the occurrence of it and the impact that it has. Most companies still do a subjective evaluation, but as Bhargav Dasgupta talked about it, that they've quantified the impact and therefore trying to understand what it means. We've been doing this for the last couple of years and with some success, but I think COVID has sent us straight back to the drawing board and having to figure out things again. Creation of a heat map to prioritize risks. Each risk is managed by a risk owner or a SPOC. Focus on embedding risk management in business processes. Now, while we have always viewed our business as being providing a service, the reality is we are now having to embed a lot of the risks, risk management and the mitigative factors into our business processes because of the changed environment. Can you change the page, please? Before I conclude, I just want to talk about the Risk Management Committee. As I said, we've had an internal risk committee within the management team for over 20 years. That committee has the minutes, the report of that committee is presented to the audit committee every quarter. But I think with the Risk Management Committee, what I believe in our industry is that the Risk Management Committee needs to determine the adequacy of the policy given the external risks, many of which have changed and need to be reviewed again. The adequacy of controls and processes. It's not just restricted to COVID, but I think one of the speakers talked about how processes, we are still in stage 3 in terms of leveraging processes, whereas technology has moved to level 5 or level 6. How do you leverage off that? The adequacy of cybersecurity and data protection. I'm actually going to call Bhargav on Monday and ask him if he's given me enough security, enough insurance against ransomware. But the reality is I'm not even sure whether we have enough insurance or not. Management ability to assess and mitigate risks. It's a whole new ball game for us. And we've spent a good part of the last 15 months trying to address some of these factors. And we now put it together and have built literally a bottom-up risk policy, which looks vastly different from the risk policy that we had 2 years ago. And lastly, related party transactions. The Thomas Cook India it has got several group companies where it buys and it uses the services of these companies. I actually believe that the risk committee needs to assess this part very carefully, because though the audit committee looks at the here and now, the reality is that the risk management committee needs to look at this to understand whether Thomas Cook India, is conducting. It's not just conducting the arm's length and everything else, but is following a policy that is adequate to mitigate some of the risks that shareholders may have. Thank you very much for giving me the opportunity again, and I'm open to any questions if there are.
Thank you very much, Mr. Menon, for the words drawn out of the multiple years of experience in your industry. Thank you very much. JS, kindly take on the questions, please.
So let me shoot the first question right away. Social risk, I think that is what is actually the biggest risk in tourism industry today. So Jyotsna is asking, how often do social risks get considered in a risk management committee?
Well, we consider social risk today in the risk committee that is run by the management, but it is an essential element that we are going to consider. We are going to ask the risk management committee to handle. We do have certain processes around dealing with it, and we will expect our independent directors to determine whether they're comfortable with that or we need to exceed what we're doing today.
Because ESG has already become a very big thing now, environment, social, and governance. So I think that audit plus the social audit, I think all of these are going to be playing a very prominent role, that too in the tourism industry. Yeah.
Sure. You're absolutely right.
So the second question is from Jayanti, who says legal risk. I think the second big risk is the legal risk, where every consumer wants to file a consumer complaint against your company. That's the trend. So how would the risk mitigation plan be from a risk management committee perspective?
We have a very detailed process in dealing with complaints. To start with, let me just mention this, that my email address appears on the website right in front of anybody who wants to complain about the services that he or she has got from the company. So very often the complaint lands in front of me before it even hits the rest of the company. Therefore, we start trying to manage the complaint and talk to the complainant as early as possible. While, for example, just to give you an idea, somebody's on a tour and they find that something is not to their liking, and they do complain. And mind you, I can tell you, they don't have my mobile number, fortunately, otherwise I'd get called late at night. But the reality is that we try to deal with it immediately. We've got tour managers on the ground who will address it. So there are multiple levels, there are escalation matrix to deal with this. The number of legal cases that we fight are not significant, but they are sizable enough. But I would like to believe that we address issues significantly right at the beginning. So we've reduced the likelihood of legal cases as a result of that.
Yeah. There is a question from Bhaskara who asks, what is the anticipated revenue drop or market size reduction for tourism travel industry?
So as I explained, within 12 hours, I went from being a hero to a zero. For a good, out of the 15 months, for a good 10 months, we had no revenue. For the last 5 months, we've had spikes. It's literally started at 100% drop in revenue. Now we are slowly sort of climbing our way out of that hole because people have started traveling. But the reality is, that's only one part of the story. But look at the impact that it has had on an industry that is dominated by mom and pop shops. I worry every day when things come back to normal. Now, it may be good from a larger company's point of view, but the reality is the number of unemployed people. I don't know if people realize this, but nearly 9 million people in India related directly or indirectly or peripherally to the tourism industry have lost their jobs in the last 15 months. People have seen salary reduction. We ourselves reduced the strength across all our group companies by 1/3 in May last year because we didn't know what we were going into. We figured that we'd use this time to bring in technology, which we have done, to try and replace some of the jobs, and we'll never go out and recruit a lot of these people again. So there are both sides of the coin, but it's a scary experience, let me assure you.
So as an amazing entrepreneur, do you have fear of a business continuity? Because I have the next speaker from KPMG, so you could just...
I never worried about business continuity as being my top risk before, let's say, COVID happened. And mind you, we've seen some disasters along the way. It was Kingfisher, it was Jet Airways. We've seen some of those problems. But post-COVID, continuity has become the primary focus area. But I must mention one thing, which, my majority shareholder is Fairfax Financial Holding, and they taught us something in 2012. It's called free cash. We are measured, our performance is measured on free cash, as a result of which we went into COVID with a sizable cash balance. We continue to have some of that even today, and therefore it has reduced the risk of survival and consequently continuity.
Yeah, so that was nice of you. Thank you so much for being here. Over to you, Rajiv.
Thank you very much.
Thank you, Mr. Menon. Thank you very much. Ladies and gentlemen, now we move on to our last speaker for the day. That is Mr. Vijay Chawla, partner and head life sciences and head risk advisory for KPMG in India. While organizing this webinar, we were very particular in having the views of a renowned consultancy. It is such consultancy companies that advise and guide the organization in their path towards the effective risk management. We kept him as the last speaker because as a consultant, he can draw from the wisdom of earlier speakers and show the way forward to the audience for how the risk committees can deliver. Now, about a bit about his biography, Mr. Vijay has been with KPMG in India since 2001, wherein he heads the life sciences sector and is the risk advisor for KPMG in India. With over 2 decades of experience in pharmaceutical, manufacturing, IT and ITES, food and beverages, Vijay has successfully led various advisory engagements on business risk management for ethics and compliance, corporate governance, etc. In his vast consulting experience, he has led several complex enterprise risk management framework assessments and implemented projects for large business houses. He's also led several SOX implementation projects and COSO 2018 framework assessments. His extensive domain expertise also led him to prepare recommendation for SEBI's committee on the topics relating to corporate governance. Mr. Vijay's experience also spans to include quality assurance reviews entailing executive and board interviews, standard gaps analysis, peer benchmarking, 360-degree feedback, and the list continues. He's also the global lead partner for one of the large pharma company and one of the large IT and ITES companies in India. He is the member of Institute of Chartered Accountants of India. Without wasting much time, over to Mr. Chawla.
Thank you very much, and good evening, everyone. I know this is not the best time to kind of talk through the last part of this whole session, but I think it was very important that I cover some aspects of what was not covered earlier. I will try and keep myself brief considering we've already overshot time.
and I will not repeat what the other speakers have said. Brigadier, should I present or?
No, we'll do the needful. Kiran, please do the needful, please.
Yeah. Thank you so much. Yeah, if you can move to the next slide, please. The next one. So I think a lot of speakers have spoken about several risks. I think a couple of things that I wanted to present today is what faces the risk committees today largely. And I'm not covering everything, but just covering 3 or 4 things just to kind of joggle between what others have said. If you look at ESG, I think not much spoken earlier, but I think this is something that a lot of companies today are focusing. A lot of funds from Europe particularly are focusing on this. And this is gaining a lot of traction today as we speak. It is quite important that the whole ESG agenda is now back on the table for risk committees to assess what companies are doing. It's not easy. It's a new topic. You can't refer to too much of past guidance here. You can only refer to something which is global. I think India is evolving here, quite an important one. I think previous speakers have spoken about cyber. Couple of things I just wanted to mention here. I think one of the previous speakers spoke about the risk that today poses because of data privacy and data governance. I'll just give you one simple example. I had a friend of mine, a young friend of mine, who I met last evening, and he works for an IT company. And he was telling me that earlier he couldn't carry his mobile phone while working into the organization because there was a threat of data privacy or data security. And today what happens? When people are working from home, I'm not sure how much of data is still secure. We can have endpoint encryption, we can stop emails, but there are still risks that are there today, which companies should evaluate. And there is a way to kind of mitigate those risks. Not easy, but there is a need to mitigate that risk. People did speak about pandemic, saying, was there a crystal gaze earlier, saying, could people have anticipated this kind of a pandemic? The answer is clearly no. But now with the pandemic, are we ready for the next crisis? I think Mr. Menon also spoke about the free cash flows, and that is something that I wanted to cover. But having covered that, I don't think I want to repeat myself there. This whole session has been about technology. I think disruptive technology is something that I want to highlight. And the reason I'm highlighting is that at least boards need to know, the risk committees need to know in terms of technologies which will disrupt their business going forward. And the question is, how much is it going to be disrupted and what can be done about it? If we can move to the next slide, please. Yeah, evolving risk. This is just to highlight, the next slide, please. This is just to highlight what the World Economic Forum, actually, how was it that they were looking at risk? And what you will see over the years, I've just plotted from 2012 to 2021, and this is based on the likelihood of the risks globally. And you will see that every year there have been changes to the risks. And today you will see very, very different risks compared to what it was in 2015, 2016. Very few risks actually continue, which means that we need to be agile. We need to be actually monitoring each risk as the day goes by. If we can move to the next slide, please. This is again just depiction of based on the impact. Again, same story. You will see every year has been a different risk altogether. Next slide, please. Yeah. Now here you will see just in terms of pre-pandemic and post-pandemic. If you look at today, and we did the CEO outlook, and we realized that one of the biggest risk companies are facing today, and I was a little surprised that nobody spoke of this, is the talent risk. Today, companies in Bangalore, I'm sure many of you are on the boards, you will notice that there is very, very difficult need, or there's a big need for talent today, and it's very difficult to find them. Supply chain, the pandemic taught us, saying what was never an issue continues to be an issue today. China continues to be a threat, especially in the pharmaceutical sector, where APIs come majoritarily from China. Today, that's a very, very big risk. Supply chain also continues to be a risk because we spoke about consumers turning to digital today? How do you reach to them? And how do you reach when there are so many uncertainties in terms of the supply chain today? Can we move to the next slide, please? Yeah, the next topic is something which is totally different. I think today we're speaking about risk, but what is very important that we've learned in KPMG is sometimes just a two-dimensional view of risk is not sufficient. There are areas where there is interconnectedness of risks, and it's quite important for companies to evaluate this. Let me give you an example that today, if there are 10 risks and each of them in isolation may not be as large as the top 10 risks. But once you interconnect few risks, it is quite possible that you arrive at a cluster of risks which is far larger than what you had anticipated before this kind of interconnectedness. And this is called the dynamic risk assessment. It's not a new theory today, but what I'm only asking participants here to focus on that this is something that companies should evolve and should look at risk clusters, prioritize these risks based on these clusters, and quite possible that there is a significant change in the strategy to addressing or mitigating these risks once you look at a cluster. Can we move to the next slide, please? Yeah, so how do we look at dynamic risk assessment? One is evaluating the interconnectedness and of course plotting it based on the risk appetite that the company has and looking at the likelihood and impact of each of these clusters and addressing this risk. I think somewhere there was also a discussion about tools in making sure that the risk mitigation is mapped and also addressed correctly. There are many tools today in the market that companies can evaluate. But what is the need? The need is basically for companies to actually ensure that what has been identified is actually carried through in terms of implementation. I can tell you based on my experience that many companies do reasonably well in assessing, identifying risks. But in terms of implementation and mitigation is where many companies today fail. So risk committees are actually evaluating risks, one, which were identified a year, 2 years, 3 years ago. And also the mitigation is not followed through right to the T. You can move to the next slide, please. The next one. Yeah, I'll jump straight into what needs to be done. And this is where I think we need to spend a lot of time thinking through what needs to be done today. I think there's a desperate need to review and rethink what and how to do it. Because today the disruption and the technology changes have taught us saying what you could do in the previous year and how you could do it is very different from what you can do today. Diversity, very important. I think there was a lot of talk in terms of what is the composition of risk committees. There are various aspects today, various risks that each company actually faces today. And there is a desperate need for people to have this diversity in thinking in terms of skill sets. And that's significantly important. Corporate governance, like I said, these committees have to ensure that it is followed right through in terms of implementation, making sure that people are accountable for whatever risks that they are actually owning up to. So they need to own the risk, they need to own the mitigation plan, they need to ensure that there is transparency when it comes to the risk committee to measuring KPIs in terms of progress. We've seen in several cases that KPIs are not necessarily measured. In the sense, there is enough discussion on the risk, there is enough discussion on the mitigation, but is there sufficient tracking whether the risk is actually mitigated or are we on the path of mitigation in the right way? Finally, I think what is important, and this is something that I learned when I was doing this for a client of mine, where we were to prioritize risks. And this was a big learning that the CEO stood up and he said, the way we should prioritize what risks to focus on is dependent on which risks actually impact the purpose of the business. And that is why I did make this point saying, embed purpose into the business strategy, because that will define as to how do we what should be the appetite for each of these risks. With this, I think I'm done with my discussion. I hope I tried and completed this whole session much quicker than I thought. Happy to take questions here.
Thank you very much, Mr. Chawla, for such an informative talk. And over to Mr. Sundaresan. And subsequently, you can always take the questions from the audience also. Over to you, Mr.
Questions are pouring in, actually. Don't worry, Vijay, I'll keep you engaged. Okay. Now, I was reserving the best question for you, because these are sensitive, which I could not ask the previous 4 speakers. ILFS is the biggest tragedy in this country. There was supposed to be a risk management committee. Sorry, there was. That comprised of R.C. Bhargav, Michael Pinto, he kept on asking Pinto ko gussa kyun aata hai, and then Arun Saha, and then Bandopadhyay, who is LIC nominee. Trust me, all 4 are big in their own. It is said that during the crisis period, which is 2015, this risk management committee met only once. When I asked the directors why they did not meet, they said, no, we were never called for. A meeting was never called for. I mean, that on a lighter side. But when it comes to an auditor, where were you? I mean, you means whoever was auditor. I mean, how could somebody not take this risk management committee seriously as an auditor? So what is your perception?
Well, I don't think I want to comment specifically on ILFS, but I can tell you that today, the seriousness with which SEBI is driving it, with which the regulators are driving it, I think there is enough seriousness today in many companies. And I can still tell you that while it is recommendatory for companies, we should actually make it mandatory. And the sad part of it, Mr. Sundaresan, is this, that we only drive when the law drives us. And there is a strong need for the lawmakers to listen today that there should be more regulation on the risk committee. Having said that, I can still tell you that many listed companies today don't have a framework. And sorry to say this, but the responsibility has to be shared amongst the stakeholders. It has to be the board, it has to be the auditors, it has to be the internal auditors, it has to be everybody who has to take ultimate responsibility in terms of driving the risk culture.
But Vijay, you know, one small, sorry to, many times I come across people saying, hey, there is an audit committee, why should I bother about a risk committee? So this is the question I tried to pose in the beginning also. So do you think this is like an escape route or something like that where, or like that Jaspal Bhatti, committee ke upar committee, so, or it's a mockery that we are having too many committees. Do you think there is a clear demarcation between a risk committee and an audit committee?
Snip, very, very clearly. Actually, I wanted to, come in there when this question was asked. I see a significant difference between an audit committee and a risk committee. There are many topics outside of the financial risk which are being discussed in the risk committees. Let's take examples of disruption. I think Mr. Menon spoke about free cash flows, right? These are the points which the risk committee has to take note of. And this is where I think the risk committees feed in very well into the audit committee and into the board, actually asking them to drive the right way. And I sincerely feel the roles are very, very different. And there is a desperate need that the risk committees actually take serious action.
Yeah, on that note, I think what you said is brilliant, because Nestle, I believe the Maggie related issue was handled by the risk committee and not the audit committee.
You're perfectly right. You're perfectly right.
So this is a clear demarcation. That's what I want to drive home the point, because last 2.5 hours, we have been deliberating on what this risk committee is all about. So thank you for clarifying that. Now, let me just go to the questions. Mani is asking, how are emerging topics like bribery and corruption, conflict of interest discussed within management teams and in risk committees?
Oh, I think Mani, very, very good point. And I know you're a champion in this. Today, I can tell you, just that many companies are looking at ethics and compliance very, very differently. You've seen the DOJ, the SEC taking strict action in many places on bribery and corruption. Today, if you look at industries, there are many industries today where the practices are very different. And I think there's a desperate need to have an overall framework for ethics and compliance, and it should be as serious as the ERM, if not lesser. And the risk committee actually should own the culture of ethics and compliance.
Correct. I think the charter itself should be different, right? I mean, audit committee deals with certain related party and financials and all that, and risk should take care of all this bribery, anti-corruption, crisis management. I think the risk management committee's role is huge, and it's such a sad thing that only now we have come to the 1,000 listed companies. We have 7,000 listed companies and about close to 10,000 large public companies, actually. I mean, so long way to go, but I think...
Jayesh, you'll be surprised that there is a UK code of conduct which is being released on corporate governance in 2019. And they said that the board chairman should actually drive culture.
Okay. That's a very good point, actually. Yeah. Yeah. In fact, what I do is I call myself ECG specialist, nothing to do, ethics, compliance and governance. But three emerging issues are environment, culture, geopolitical. I think a lot of discussions happened around culture and social this thing, but environment, I think you covered it a little bit, which is going to be a huge thing, right? I mean, climate is going to become a big thing. How do you think ESG will pan out?
Well, today, if you look at investments are happening in clean companies. They're talking about what is the strategy. So I can tell you that today several companies are approaching us, asking us as to what they should be doing on ESG. While I can tell you many companies are actually doing a lot, but do they have a clear strategy? Are they communicating it the right way? And are they measuring themselves in the right parameters? It's very easy to say we'll get carbon neutral by XYZ date, but what is the plan to get there? So today, a lot of investors are asking a question saying, you made this statement, can you tell us what is it that you're doing to get there? So I think there is a serious need. I will not be surprised that 5 years from now, investments will happen in companies who have a clear map on ESG.
Super. In fact, that's a precursor, or I would say trailer for our next session, actually, which is going to happen on ESG. Thanks for that. Now, Pramit asks you a question, which is, what are your thoughts on climate change as one of the emerging risks and the kind of repercussions it could bring to the business? Should we act now or watch closely? Could this risk be converted to an opportunity?
Oh, yes. Today, a lot of companies are actually looking at this very, very carefully and assessing what opportunities lie in them. So there are many industries today, many sectors today who are looking at it very, very differently. Just look at companies which are in the renewables. There is a clear runway for them as we move along. And as I think countries sign up to this climate change, which is coming up, I think there is immense opportunity out there for companies. So just look at how many companies have set up captives on solar. And that's the way I think it's going.
Yeah, I think that's going to be the end thing. Actually, solar is becoming a big one. In fact, IOD had done a program just 2 days back. UP government and Andhra Pradesh government has just opened their doors for anything that you talk on solar. So I think, yeah, that's something that we need to look up. Margaret is asking, what is the mitigation step for managing the talent risk, which you covered, where the companies have given in for candidates window shopping?
Yeah. See, a lot of companies, mostly in the ITES, are today facing a big risk. We consulting firms are facing a big risk. And the way we are addressing talent, I can tell you, is trying to assess, one, how do we retain people? Okay, money is just one part of it. Compensation is just one part of it. Talent management, talent retention is a very, very broad and big topic. Today, we have to look at it from a very, very different perspective on ensuring the top talent is retained, but also reskilled and upskilled. And today, I can tell you, I think there was also one speaker who spoke about connecting with people, right? With this pandemic, there's absolutely no connection between the employees. And today, this could be one of the big reasons people are leaving. So not an easy answer. I don't think I can answer it within few sentences, but this is a big risk for companies.
Yeah, so I think talent risk is a big risk which should go as one of the agenda items in a risk management committee, I feel, that's one of the tick the box actually. Bhaskara is asking in life sciences, pharma industry, continuous manufacturing technologies, adapting companies have strong competitiveness. Now the question is, how do they cope up with the delivery speed risk with their competitors? What measures do KPMG proposes? Maybe you could take that offline and bill him.
Yes, I can surely recommend offline, but I can tell you today there are many new technologies which have come to ensure that supply chain management is no longer an issue that was there 5 years ago or 2 years ago. And you'll be surprised that once you interact with these new startups, the way they have actually addressed these issues. There are many companies today, much smaller in size, but they've actually resolved big problems for supply chain.
I think there are a lot of good questions coming in. Rajiv ji, do I have three? The nation wants to know. Do I have 3 more minutes?
Yes. Please go ahead.
Thank you so much. There's so many. Money is asking. In most of the examples of impropriety, the management override is responsible. Can RM program really control that? Amazing.
Again, 2 things. One is tone at the top is very, very important. I'm sure everyone over here understands how important the tone at the top is. This is a risk not only for the CRO, but this is a risk for the auditor. This is a risk for the CFO, and something very clearly that while it's not easy to address it, but the structure in which and the authority with which the CRO operates is very, very important. There has to be a clear line of communication between the CRO and the chair of the board. And I'm actually saying this very particularly saying the chair of the board. Because if there are cultural issues, it is up to the board chairman to address them.
So you are casting the onus on the chairman. Okay. Now let me
and yes, today you know that there is also a directive that the executive and the board chair should be different, right? So there is enough corporate governance in terms of policies that are coming in that direction.
Okay. Ravi, I think 2 people had put their hands up. Can you just identify, maybe they want to speak in person, just identify. Meanwhile, I'll ask a question to Vijay. I can't leave this opportunity, Vijay. Yeah. So what is the auditor's role in identifying risk? Should the auditor be dependent on the management to expose risk?
Well, today there are sufficient tools that are used in audit. Well, you can see this clear role definition is there as to what an auditor should do, can do, and should not do. It's not the auditor's job to run behind identifying risks, but it is the auditor's job to ensure that there is enough framework in place and controls in place to identify, assess, and address the risk. And it is, I think, the auditor's role today to making sure that those controls are effectively working. And if there is a breach, again, there is a need for the auditor to respond to it appropriately.
Beautiful. Okay. So now, before I move on to the other panelists with one last question, one question to you for the larger interest of the audience. Going concern, business continuity, and gone concern. Gone concern, though you know it's gone. So between these 2, what is the difference that a board member should be aware of sitting in a risk management committee?
Well, a going concern is a much broader risk in the sense where the company needs to ensure how it's going to end in terms of ensuring that the stakeholders who are involved are also aware of this risk of going concern, right? So I'm saying that's a stakeholder management, that's a communication, that's a far, far bigger risk to be addressed. in terms of business continuity, I think Mr. Menon also mentioned that there can be ways to mitigate that, right? Short-term funding, making sure that there are controls in place to ensuring that not one location can pose a bigger risk. There are ways of mitigating business continuity. But going concern, gone concern is a far bigger risk for the board to handle. And it's a very delicate topic in terms of how that is communicated.
Oh, that was very clear. Yeah. So because this is in connection with Jet Airways, okay? I mean, where if you're sitting on the board as an independent director of Jet Airways, I mean, the board did not see, auditor did not see, only the promoter saw it. He went to the balcony and said, from tomorrow, my company is shut down. I mean, that's the biggest unknown. In fact, that's what Mr. I had started off this session with. And if you permit, I will just pick that question somebody has asked on Cafe Coffee Day Siddharth. Okay, the beautiful question that comes, which is that unknown is, the question is, how do you sitting inside a risk management committee see it coming? So let me start with Ganesh. A Cafe Coffee Day scenario and you are on the risk management committee, how do you see it coming? Just short, a very brief answer.
No, I think if you are focused on looking at risks over a longitudinal period of time, you can see trends. I mean, there will be weaknesses in some aspects. So I think you just have to have a risk management framework which tracks and are able to identify potential risks much before they become a disaster. So I think that's very, I mean, some things like the Satyam case, which are very difficult to spot early, but I mean, there will be.
No. This is another unknown, which is Siddharth just decided to go and take a dip in a river and never came out of it. So as board members, we need to be very, very cautious, right? I mean, that's the biggest risk that many boards are facing, where the uncertainty of the CEO itself, existence of the CEO.
No, sir, for that succession planning is essential. So if you don't have a second line, it's never going to happen.
No, that was the answer. Yeah. So Bhargav, what is your take? I mean, as an insurer, a coffee day, suddenly the CEO disappears. Forget the insurance part of it. I'm only asking about the business continuity part.
No, I think Ganesh responded. I mean, at a board level, you have to think about succession planning. Again, not practiced well across the industry, but it's vital. You have to think about someone being hit by the bus. And I think the other point that Vijay also made in terms of the tone from the top, a lot of that element is missing. A lot of times we follow checklist approach, right? I mean, and in some of these examples that you're giving, even Satyam, right? So all the checklists, if you look at the quality of board, everything was ticked. But if the message from the top is being managed, it is almost also very difficult for the board to figure that out.
Yeah, I'll give you a tip also.
Yeah, and in a sense, knowing who the leader is very important, and his values.
Yeah,
her values.
This is what I call third eye awakening. All of us should get. Yeah. So before we close, Mr. Menon, you listed out so many risks. Now, climate risk is one of the, which of course Vijay dealt it so beautifully. That's the biggest risk that I see for tourism. Now, what do you, as a person running the company, how do you handle that risk?
So I think one major advantage we have is that our business is very seasonal. So we try and, within those seasonalities, try and address the issues that could potentially arise around these such risks. Let me give you an example. So, for example, we send people on cruises out of Miami, and there are parts of the year when there are tornadoes that are floating all around that area. We avoid those periods. Now, I'm not saying that we get it 100% right. Yeah. For example, when the Bahamas had its major tornado, we were very lucky that it didn't hit the main island where we had tourists at the time, but it hit another island which we never happened to visit. But very often we are able to use seasonality to our advantage. Not all the time, but for a good portion of the time. So climate risk is something that we look at very closely when we build our products.
Yeah. Thank you so much. All of you were wonderful. And want of time, I still have so many questions, but this can go on throughout the night actually. So thanks, and over to you, Rajiv. Thank you so much.
Okay, thank you, JS. Thank you very much. Ladies and gentlemen, now I invite Mr. R.G. Rajan, former chairman RCF and former chairman of SCOPE and member of the Governing Council and All India Director of IOD, to give his concluding address. Over to you, Mr. Rajan.
Yeah. Thank you, Mr. Kapoor.
Thank you, sir. Thank you.
And today we had an excellent webinar on the theme, Can Risk Committees Deliver? And I would like to summarize the points made by each speaker in a very briefly. Mr. Akshay Bhargav mentioned the classic role of risk committee in identifying, evaluating, and mitigating operational, strategic, and external environment risks. And he talked of three unknowns. Talked of the three knowns and unknowns. He talked of known knowns, the known unknowns, and the unknown unknowns. And obviously, the unknown unknowns tend to be the most difficult ones. And he also made a very interesting point about this cyber risk, cyber security, which we are facing all over the world. And he said that India is at the top of the list in facing these issues. And around 70% of the companies in India, almost 2/3 of the companies in India, have paid some ransom, as against 1/3 globally. So this is a food for thought for all the Indian companies as to why we are more vulnerable to such hacking issues and how we can overcome them so that we can have do the business in a much better manner. And he said the trends in the business are very clear. The consumer will become only digital now. There are some consumers, the G generation, the Z generation of the youngsters, who only interact with mobiles and nothing else. And he gave a very good example of this response by email and SMS, and of course in WhatsApp. Mr. Notrajan added that probably people today respond more to WhatsApp than SMS and email. And even I don't see my SMSs very often. I'll see my WhatsApp very often. So obviously people respond to what they see, not what they do not see. And second thing he said is that quantum computing is coming in a very big way and will change things. And it'll have a big role for the cyber criminals. And also they have a good role for the technology innovators. And third thing is that the central bank digital currencies will be coming, and the banks may all disappear in the future. So there's cause for consideration for many banks today. And he has said that the risk committee should ask the right questions about each trend and decide about the same. They should watch closely, develop strategy, mitigate actively, and act as per requirement. The next speaker was Mr. Ganesh Notrajan. He spoke about the various technologies such as cloud computing, IOD, and robotics, and mobile technology, artificial intelligence, and machine learning. And he also said that the COVID has accelerated the digital collaboration in a very big manner. And today we have an ultra-low cost template with price transparency and usage-based pricing. And consumers becoming more and more empowered, and the process across industry segments have to go on re-engineering and should work on the digital platform to a large extent. And he spoke of the dark world, DARQ, dark world, where he said that the ledgers will become distributed and blockchains will be everywhere, and AI will reimagine the future of work. Reality will be mixed, virtual and augmented, and quantum computing and 5G will make anything possible. And companies will have to adopt a roadmap for adopting the new technology, including understanding our position, defining strategy, the need identification, and fulfillment in the business process, and assess and reassess risks, and measure and manage success. Last point, he said that business should be flexible and secure and well re-engineered to face the new future. Mr. Bhargav Dasgupta said that some risks have no history. Like COVID has had no history before. Though it had a history in the early 20th century, but there was no such documented things. And it can spread fast and take new forms, like COVID variants. And again, he talked about the dark side of technology, like this disabling of IT services for early system failures, the cyber threats, the hacking of the driverless car platforms, and the interconnected system crashes. So we need to have a new way to assess the risks and take it forward. The risks have to be measured using scientific risk measurement tools that can break risks into multiple elements and quantify them for actionable points. What he says that some risks are always inevitable, but we have to put measures in place to minimize the impact, ensure the overall awareness and readiness among relevant stakeholders, and taking the help of insurance to be ready and to face the future in a better manner. The time for new age insurance has come, and new age risks demand the new age value added solutions. Mr. Menon spoke about the tourism sector and says that first to get hit and last to get out. And they both have the internal risk and the external risks. And obviously they have the human risks very much. And of course, we have the economic slowdown, the cyber security problem, the legal risks is there, the political risk is there, and there are so many others. Brand reputation is there. And he said that the major impact has been felt on the pandemic in this sector. And also they have to face the new technology every day, like facial recognition or virtual reality. Natural disasters play a very big role in their risk management. They have to take care of that. The political uncertainty is very much there in all countries closing borders, and financial resilience. They earlier had a negative working capital, which now has been disrupted. So ultimately, the human factor, human anxiety, human mind is very much important in such businesses. So Chawla was the last speaker, and he spoke of the various challenges faced by these committees. The ESG is very important. We have to assess the ESG and disclose it properly. Cyber data privacy and data governance. And how the response to pandemic, how much resilience we demonstrated, and are we ready for the next crisis if it comes? And the technologies are being disrupted. Either we disrupt technology or we get disrupted. So what he says that ultimately we have to go for the recent trend is that the dynamic risk assessment. Review and rethink what you do and how you do. The diversity in everything, including composition of risk boards. Strengthen corporate governance, embed purpose into business strategy, ensure accountability at all levels, and prioritize risks. Very last point, important point he made that investments within 5 years time period, investments will happen in companies which take care of ESG. And that is a key point to be taken away from this webinar. I now conclude my address by thanking our sponsors, Coal India Limited and Mahaga Gas Limited, for sponsoring our webinar as principal partners. I also thank all the participants in the webinar. We had more than 130 or 140 participants today. I also thank Mr. Sundaresan for so wonderfully comparing the Q&A session and asking some very good questions and also asking some difficult questions to the speakers. And we got good response from all the speakers. I should thank the speakers for giving very good response to all the questions asked by Mr. Sundaresan and also asked by all the participants. I also thank Team IOD at the head office and also at the Bangalore office for organizing this webinar in a very wonderful manner. Thank you very much. Till we meet next time, maybe 3 months from now.
Thank you very much, Mr. Rajan. Ladies and gentlemen,
thank you.
Yeah, with this, we come to an end to this engaging and enriching webinar. So, and this, I would just like to thank our back-end IT team also at the same time, who have been a great support to us. Thank you, ladies and gentlemen. Stay safe and Jai Hind.